officials are likely to seek a rollback on export controls, tariffs, and restrictions on investment in the United States.
We're going to ask for one thing, and we're going to give up another. I saw an interesting couple sentences of speculation about what America would do with human rights. But to your point, John, on tariffs, maybe that's a surprise here in that the tariffs that were wrought over the last 5 years begin to be discussed, or dare I say, even dropped.
I think this is about dialing back the thermostat at this meeting.
Oh, much better.
Yeah,
much,
not about big policy shifts.
It's not a wonk meeting.
No, for this market though, Peter Chia, Academy Securities, had this to say in his note that he put out yesterday afternoon. Be prepared for the meeting this week to come across as highly conciliatory, prompting and everything rallying to year end, Lisa. We don't even need to see concrete actions taken. If the messaging is strong, that messaging should be enough to get the job done. And that's kind of what people are expecting this week, right, over the next couple of days.
Pick your reason. The rally will continue. That seems to be the sort of theme from Wall Street. I will say, in terms of the conciliatory tone, Xi Jinping was talking about Taiwan and having more of a closer business relationship with that region, which again is a softening in tone. It all goes to that mood music that you're talking about.
Let's go to the mood music in Washington, improving just a little bit. House lawmakers voting to pass a temporary stopgap government funding bill, greatly lowering the risk of a shutdown. House Democrats bailing out newly elected House Speaker Mike Johnson to pass the legislation, with 209 Democrats joining 127 Republicans in support of the measure. The legislation now goes to the Senate, where majority Democrats are expected to back it, even though it doesn't include aid for Ukraine or Israel. So it sounds like happy families down in Washington, D.C. It was anything but elsewhere on Capitol Hill. A congressional hearing on labor coming close to a full-blown fist fight. Tensions boiling over between senators and a witness. Oklahoma Senator Mark Wayne Mullen, who's a former mixed martial arts fighter, losing patience as he read aloud a hostile Twitter interaction between himself and the witness, Teamsters President Sean O'Brien. It took 82-year-old Senator Bernie Sanders to come between them.
Sir, this is a time, this is a place. If you want to run your mouth, we can be two consenting adults. We can finish it here.
Okay, that's fine. Perfect.
You want to do it now?
I'd love to do it right now.
Well, stand your butt up then.
You stand your butt up.
Oh, hold on. No, stop it.
Is that your solution, everybody?
No, sit down.
No, you're a clown.
Sit down.
Okay.
You know, you're a United States Senator.
You're an embarrassment. You're an embarrassment.
They went silence after
An embarrassment to the state of
This hearing is about the condition of the working class in America.
That's what we're talking about.
You're the biggest thug here.
Absolutely lost for words. The first time I saw that video yesterday, I thought it was a spoof, Bramo.
I said it
had to watch it again.
Exactly.
I had to watch it twice, 3 times, 4 times. Couldn't stop watching. Absolutely ridiculous what is taking place in Washington.
My favorite is Bernie Sanders with the gavel being like, would you guys quit it? Just stop it.
There were some very funny moments in that hearing. What's funny about the whole thing, though, is no one really knows what that hearing was about. All we've walked away from is with those images, Lisa.
Well, but this is the issue, and not to be serious, but there is this feeling that that's what's going to catch everyone's attention, that from that House resolution that passed, we're going to be talking about Kevin McCarthy possibly elbowing another Republican Congress member. We're not talking about the substance and how much is that the Bernie Sanders, what he's fighting against, and he's kind of fighting an uphill battle because this is made for TV.
Maybe we thought it was over and made for TV, and I do take your point, Lisa, that this was playing for the local constituencies, who's ever involved. But this goes back, think of the movie Lincoln, Daniel Day-Lewis, Sally Field. Charles Sumner's in the movie, and the most famous event in Congress was the caning. They all used to walk around, like John, like you walk around with the cane, you know, the London cane. The caning of Charles Sumner years ago. There's a history of this in Washington.
The senator that we're talking about that was included in that interaction actually referenced what you're talking about.
Oh, did he? I missed that.
Later on in media.
Later on, excuse me.
Had a conversation about that, yeah.
I just, you know, it's really, really sad. I was on the phone yesterday with someone in Washington, and they were almost crestfallen about it. You know, it's like, we're not supposed to do this. Do they do this in London? I mean, every time I've been to House of Commons, it's like convivial.
I think we stopped caning each other a while ago, Tom.
Yeah, thank you.
Yeah, I'm not sure anyone wants that back either.
We don't cane economists either, so he'll stay with us. Bruce Kasdan with a brief this morning. In these extraordinary times, chief economist, head of global economic research at J.P. Morgan. Bruce, it's a time to reset for 2024. A lot of us would suggest we got wrong 2023, and to me it centers around productivity. Austin Goolsbee of Chicago talked yesterday about a productivity that is a mystery, that's out there. Are all these good feelings happening because finally we have a new level of productivity in America?
I think it's a little early to say, but the news has been good. We've been running over the last 4 quarters a little over 2% on productivity gains. That's almost a percentage point above what we averaged the last cycle. Some of that comes because we've had strong growth, but there's been pretty solid investment for some time in intellectual property and R&D. There's certainly a case to be made here that we're getting some improvement. And I just would note that the supply side performance of the U.S. has also been helped by strong labor force growth. We've been running much faster on immigration flows, and we've been getting the labor force participation rate of prime age workers up. So, some of the optimism, I think, on the U.S. comes from the fact that while we've had strong demand in the last year, we've also had very impressive supply, both on productivity and labor force.
How do you and your team respond to people that say the 3 stimuluses will drift away, we'll have the end of the Biden stimulus, if you will, and then we'll slow down again to lethargy? How do you respond to that insight?
Well, I think we are going to slow down. We grew almost 3% over the last 4 quarters, and I think it's right to say fiscal policy supports were helpful in that. And, that's not going to be there for the next few quarters. I also don't think the Fed is about to ease, so that's not going to help us. But I think what's been missed here most in 2023 is the fact that while the Fed's been tightening a lot, the underlying health of the private sector, both households and businesses, remain quite strong. So I think we will slow. But I don't think this is an economy that's at any imminent threat of anything really bad happening.
Bruce, it's been incredible to see unemployment still south of 4%, GDP close to 5%, and to get inflation converging towards 3%. I think that's the question we've got to sit on, though, just for a longer amount of time, Bruce. What are we converging towards? Are we consolidating around 3% inflation, or are we going back towards 2%?
Well, that's our view, is that we've made some good progress. We've gotten a lot of the damage done around the pandemic out of the pricing space, but that there still is a stickiness here. As you say, labor markets are tight. I think we've also shifted psychology somewhat, and you can see that in some of the inflation expectation measures. Yesterday's report was clearly a positive, and I would note it was also a positive for growth. Keep in mind what's happening in the energy space. We had a flat headline reading, but the core numbers are still running on the last 3 months around 3.5%. I don't think that's going to change in the next few months. I think the Fed is going to be patient here, but I don't think this is a victory, and I don't think we're going to be giving the Fed room to ease off the inflation numbers anytime soon.
That's what they want us to believe, and that's what everyone's going to say, and that probably will be right, Bruce. Maybe. We don't know. Does it even matter, though? Are we looking at the next 2 months? No data that's going to come out that's going to really alter this sort of Goldilocks, amazing nirvana view that seems to be imbuing markets with this glow. Is there anything that could possibly shake that, just in terms of year-over-year comps, over the next 2 months heading into year-end?
Well, I think on the economy side, from corporates, we had a very strong 3rd quarter in GDP. We're seeing that in profits. What we're going to see today, we think, is still underlying gains in retail spending. I don't think the economy is going to weaken that much. As noted, the supply side is okay. So I think the profit picture looks good. I think the economy is slowing, but not looking bad. I think there's an equivalence here, though, between an economy that can get onto a sustained path and get inflation all the way down, and one in which the Fed is going to have to stay high for long and is going to gradually erode health through restrictive policy stance. That's our baseline view, but it's going to be a gradual story, and it's going to be taking some time before we can distinguish that from the more optimistic one, where we get all the way back and have a sustainable economic expansion where the Fed can take its feet off the brakes.
So are you pushing back against market expectations yesterday for 50 basis points of rate cuts by next July?
Yeah, for sure. I think if we had a much worse economic environment, something that scared the Fed on growth, I think you can get some Fed easing. But I don't think the inflation news is enough here in terms of what we're seeing to get the Fed to think about taking anything back, at least not in the next few months. Where we're going to be in the middle of next year, I think if we got surprised by supply side and inflation, there's some opportunity to move. But that's not our baseline view.
Hey, Bruce, thank you. Bruce Kasman there of JP Morgan on the latest. I heard this a lot in the last 24 hours. You look at the market's declaring victory in the fight against inflation. You ask people what they think the Fed's going to do. They're not going to declare victory anytime soon. And I think you heard that from Bruce just then for a whole bunch of reasons. Want to turn back to Target in the pre-market. It is positive. Leaner inventories, the numbers are better. The stock is flying, up by more than 11% right now, up by 11.7%. Comp sales not as bad as expected. Third quarter sales better than expected, Bramo. Earnings look way better. Big upside surprise, 210 versus an estimate of 147.
This really stems from Target's issue trying to work down a bunch of inventory. They had a real inventory bloat, especially relative to Walmart. They seem to have been working it through, down 14%, even though at least food sales, among others, were actually down year over year because inflation was coming down. The prices were coming down. So it leads to this sort of push-pull of just specific store management rather than a larger kind of call.
NVIDIA, John, you're talking about LVMH and the rest. We go back to 2019. Let's do that on Target. And I think we forget the pandemic impact here that was just absolutely ginormous. 20-year chart on Target on radio. It's a nice typical Target trend. And John, in the autumn of 2019, boom. And all we've done is go round trip off of where we are today with a nice bounce today.
So I ran the numbers on NVIDIA yesterday. So we're talking about Target, a $51 billion name, by the way. NVIDIA, 10 days of gains, up more than 20% over that period. $200 billion plus of market cap added to that name, Bram. I mean, like, that's ridiculous, Bram.
Target's a rounding error for the gains on NVIDIA.
That's the best way of putting it. From New York City this morning, good morning.
The tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think they're doing the right thing to pause for now. You know, they've raised rates a lot, you know, to wait to see the effect on the economy in the U.S., particularly as the fiscal spending, the excess fiscal spending is winding down and quantitative tightening is kicking in. But I still think, you know, you should prepare. They might have to do a little bit more. And I think people should be prepared for that just as a kind of a risk management tool. And I'm afraid inflation may not go away that quickly.
That was JP Morgan CEO Jamie Dimon speaking in an exclusive interview with our affiliate, El Financiero Bloomberg, over in Mexico, doing some great work. I think the key line there, a risk management tool. TK, this is a business leader who runs a bank, who has to think about the risk that maybe rates stay here for a longer period of time than people anticipate, because inflation is a lot stickier than some people think.
I think the capture of profits, these guys are working overtime playing macroeconomics because they don't want to admit what they're doing. They are the second bank of the United States. Take the combined profits of the four larger banks, And it's not much different than what Andrew Jackson was worried about.
I think
they don't want to talk about that.
But it is instructive to hear kind of where they see the balance of risks, not as a Federal Reserve, but as a massive bank, the biggest bank in the United States.
And what they're gleaning from their information.
Right, but is the balance of risks shifting now to people getting overly complacent that the Fed has done? And that sort of raises this question, where is the pain point? You were asking that earlier. Is it a better than expected economic trajectory next year, or is it a worse than expected economic trajectory? That, I think, is an important thing to discern.
We have touched on something I think we've got to really work on over the next couple of weeks. What is the bet now? Is the bet that inflation is no longer a threat? Is the bet that the Fed is done? Yeah, I mean, clearly based on the last 24 hours. Does it go beyond that, though? Is the bet now that rates are going back to where they were before? 3, 2, maybe even 1% in the view of UBS. What is the bet right now?
The bet, as I can see it in Fed funds futures, is for rate cuts to accelerate into year end, but for rates to stay higher, 4%, 3.5%, not necessarily going back to pre-pandemic levels, and that the economy can withstand it. That, to me, is really the key question. The economy can withstand it, and capital markets will continue to chug along. That, I think, is actually a big question mark in terms of what the real neutral rate is. So, that's sort of the nuanced way that the market is calibrating.
You want to go to me on this?
Yeah, of course.
I say total baloney. It's a parlor game of Fed futures. What matters is the job economy, and what we're going to see, as Bruce Kasman just talked about, productivity. We have misguessed the productivity recovery in this nation.
Yeah.
And this Hotzius-Zentner divide on the unemployment rate is factors more important than gaming out the dots.
I love it when you're both on the same page without even realizing it.
It's great.
Beautiful thing.
I say something.
Marriage.
You're
It's
wrong,
total
and then repeats
baloney.
it.
It's about the nuances in terms of where rates end up.
I don't want to talk to Jen Bartash. Just Bram and I are going at it. Let us get briefed here to save the marriage. Jennifer Bartash is a marriage counselor, joins us with Bloomberg Intelligence. Jen, thank you so much for joining. I want you to explain what falls to the bottom line. Home Depot has a net income margin of 9-ish, 10-ish cents. Target, I was shocked, is 3 or a moldy 4 cents on the dollar. Is anybody making money in this business?
Good morning, Tom. It's a good question, and it's definitely one of the challenges that we always see in this retail sector. But I have to say, Target's results today were very encouraging, and it does give a little bit of optimism for the fourth quarter. So when they beat across the board with revenue, same-store sales, we did see a great increase in margin. That's all really because some of the productivity initiatives that they've put in place are starting to really help take cost out of the business.
Walmart bounced on this news as well. It's up in the pre-market by more than 1.2%. Jen, we'll hear from that company tomorrow. What is the read across from that company to the other?
Well, I think that, Target having better than expected results, it really only means good things for Walmart. Walmart does tend to outperform in environments where people are pulling back or being very careful with their spending. And so I think that a better than expected result today may lead to, a very good outlook for tomorrow as well.
But Jen, how do you parse through just the management side of things versus the macro call? On a management side of things, Target seemed to work down 14% of some of its excess inventory, leading to some of this boost. Does that really cross over to some sort of read-through in the broader consumer?
Well, I think that what we've seen is across a lot of retailers, they've had to figure out their inventory in kind of this post-pandemic world. We went through a phase where everybody was stockpiling inventory so that they had stuff available. Then they had too much and they had to clear it out. And now they're trying to find the right equilibrium. And being down versus last year where there were still concerns about supply chain constraints just shows that we're really getting back to that equilibrium. And we're seeing it across multiple retailers. And so I think what's important is that inventory is down that much, but they are already stocked for holiday. So to us, that also means that they should be able to sell through a good portion of their inventory over the holiday season and not end up in the same position they were in where they had to have a lot of markdowns post-holiday.
Jen, yesterday we were talking about drugstores in certain cities that are putting pictures of toilet paper behind the shelves and then having people request for it to be delivered to them from the back of the store. Target did talk about theft, or shrink as they call it, and saying it's still weighing on their margins in a material way. What do you make of this? How long are we going to hear about this in earnings? Is this just simply an excuse for margin pressure, or is this something that is going to become increasingly concerning for both investors as well as the corporate executives?
Actually, what we usually see in longer term cycles is that theft escalates whenever the consumer is under pressure. And as inflation is coming down, that actually should be a little bit of a release on that pressure with regards to theft and the losses that retailers are having. People generally want to do the right thing, and Target in particular has been very vocal about theft levels. We've saw some store closures where they said it was just not profitable to operate. But we do think that as inflation comes down, that should get a little bit easier going forward.
Jen, you don't do buy, hold, sell, but I want you to note a 4% dividend, an 11% 5-year dividend growth. I got a multiple of 15, which is what, 1/3 of the high flyers, 1/5 of NVIDIA in that. Can Brian Cornell and his team say we're back on plan, the pandemic's beyond us, and we will have the glide path of the Target we knew years ago?
I think we might be at a turning point. It might be a little early to say that we're already there, but I think that today's results definitely indicate that a lot of the strategies that they're retrenching, that they're putting back into place, do put Target back on that right trajectory.
Jennifer, thanks for the update. Let's catch up again tomorrow when we get numbers from Walmart. Jennifer Bartash is there of Bloomberg Intelligence. Target in the pre-market absolutely flying. Bramo, I'm pleased you brought up shrink. In other words, theft. Because Target today basically saying it offset margin improvement in particular areas of the business. I'd love some more clarity from the company on the call maybe a little bit later this morning, Lisa. I think we'd all love some detail around that because margins were better than expected.
I would love to hear details, numbers. They didn't offer any of them. It would be interesting to see if they can give some sense of how much more they were seeing margin compression because of theft and what they're doing about it, right? I mean, we talked about store closures in September. There was a lot of pushback saying, well, these stores just didn't have the same kind of foot traffic. Again, how much is this being angled in the media versus something that's very real that we all feel when we walk into a store and it's affecting our consumer experience when everything is locked behind,
Well, that's why the foot traffic's down, right?
Well, I mean
clearly.
Exactly. How do you compete with Amazon or any other pick your online shopping site if you have to go in and press a button, wait for someone?
I think it's, you mentioned the dreaded A word they don't want to talk about, which is Amazon. And Amazon's going to close their mouth on this. To me, I'm so biased by what I observe here in New York City in a lofty 3 zip codes above 59th Street. I can't imagine what I observe is across the nation as well. And on that conference call with Target today, that's really the key question to your insight. I mean, is shrink from sea to shining sea? That's the arch question.
The statement that came out in September from Target, there were 9 stores across 4 states, Tom. We had 1 in a Manhattan location, 2 in Seattle, 3 in Northern California, 3 in Portland, Oregon. This was a statement from Target. We cannot continue operating these stores because theft and organized retail crime are threatening the safety of our team and guests and contributing to unsustainable business performance. What will be upsetting for the likes of Target, CVS, pick a company, whoever it might be, is to see how quickly you can address some of these issues in places like San Francisco when someone important comes to town.
Well, the quickly is the part of it.
Can they maintain that? Can they maintain that?
Yes, but my question is, why can't we just fix this now? I mean, in the old days, it was simple. If I went into Chilson's Drugs and stole my 14th Mars bar, I was in the timeout chair for what, 6 months, 7 months?
I have to be completely honest. I actually observed it myself, somebody clearing shelves, and there was a cop on the corner, and I went up to them and I asked them about this, and I said, there's somebody in there literally clearing the shelves. Are you going to go in and arrest them? And he said, no, because what's it going to do? We're going to collar them, and they're going to get released in 24 hours, and essentially, this is going to waste 8 hours of our day that we could be doing other things. These are some of the challenges, just to give you a picture.
I'm with you.
Of the view.
You speak to the police officers, the morale is just kind of rock bottom on this issue. It's just really, really difficult, TK. Not getting support from where they need it.
I call it a solvable problem.
Coming up, Sam Stovall of CFRA on this equity market. It's up again this morning. Good morning.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of ON's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined ON as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but ON's configuration is even more unusual. Martin Hoffman also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
On the next episode of the Business Week Show, reputation.
People say, oh, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, it can be a positive step.
Watch the Business Week Show, Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
View is that the Fed probably is done.
For the Fed, yes, the bar is high for another hike.
We will get a period of slower growth, but that's not surprising.
There's disinflation in the U.S. economy, and we're heading back to 2%. The question is, how long does it take to get back to that 2% inflation threshold? And I think in that context, we have to have patience.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's the land of milk, honey, unicorn and rainbows. It's the everything rally in this equity market and in this bond market too. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive again this morning on the S&P, up by 0.4%. TK after a monster day of gains in yesterday's session.
A monster day yesterday, John, and you see it in the VIX 14.24. It'll be interesting to see how that adjusts here. But what's important is the market's lifted in the last hour. There is a continued bid to this market exactly like there was yesterday. I waited for some sense of pullback yesterday. It just never came.
Just didn't get it. Best day of gains on the S&P since April, Lisa. We went through some of the numbers earlier this morning. We'll do it again. The small caps up by more than 5%. Best day this year. Real estate gets some relief off an aggressive move in the bond market. Yields down. Real estate on the S&P. Best day in 2023.
The sound of victory being cheered across Wall Street, the victory of having won against inflation, maybe not, we shall see, but it doesn't matter. I think that's ultimately the question, and we kind of heard that tone from Ben Gutteridge, where he was saying, enjoy the spoils of market momentum. How many people are feeling the same? Ride this puppy, as you would say, Tom, to the end of the year, because it doesn't seem to be showing any signs of abating.
There's seasonality here. Ben Laidler out with a smart note today, 1/5 of the money's made in December. You know, a lot of good research on that. But, John, as we were going to air here, folks, Mr. Farrow mentioned those people that have enthusiasm, but they're really sort of kind of like not fully invested. What do you do this morning?
If you
Those
missed
are the
yesterday,
meetings.
TK, if you missed yesterday, this morning it's hard to get into. You look at moves like that, and you weren't involved. You hear from smart people like David Costin over at Goldman Sachs talking about limited upside on the S&P 500, Tom, even with a constructive view on the economy for the next 12 months. It's hard. You get stuck. You get stuck. People are talking about this big move out of cash. Cash is still paying 5%. It's difficult, Tom, when you miss these moves.
Our team continues strong. Great equity coverage yesterday. Nadia Lovell, I thought, was particularly strong from UBS. Sam Stovall with us, truly the legend with us here in a moment, John, to give us perspective on what do you do when you see this kind of bid. Was it a short cover? Was it a fake, as Lisa alludes to, or is this the real deal? And I'm going to go back to 1977 when nobody believed we would get to 1982.
I think it was a sprinkle of absolutely everything in the last 24 hours from all corners. Need to talk about Target just briefly. That stock is higher in the pre-market by almost 15%.
Or shifting back to basic necessities, or does this really indicate an all-out buying spree that indicates that strength that people are talking about, even with disinflation? We just don't know.
We don't know, but it's better news, isn't it?
It is better news.
Year end.
It's so much better news, which is the reason why.
Happy Bramo.
This is happy Bramo. I'm buying things too. I'm buying a refrigerator.
Does such a thing exist?
Lisa keeps telling us that she's spending money on a refrigerator.
I'm so excited.
Buying an automobile as well.
Yeah,
Busy weekend, aren't you?
It's going to be exciting.
The Dolce Gabbana Smeg, the one for $55,000.
When Lisa starts spending down the savings, is that a contraindicator? What does that mean?
Yes, it is.
That is John Taylor at Stanford. That's way beyond me.
Everything else is broken.
If Lisa's capitulating and starts to spend,
it is. It's
because.
What does that mean for the economy?
The same kind of enthusiasm in retail sales as we saw last month. To me, this is really key. Is it good news to see a huge bump up in retail sales, especially with disinflation, that will dampen the overall nominal levels? We also just did have results from Target at 7:30 at about 25 minutes. We do get TJ Maxx. I think TJ Maxx is going to be really interesting because usually it does better when people are looking for discounts. And so, do you look at strength in this name as a positive or as, something of a cautionary signal for the economy?
So what does luxury do? John, you've been on top of this. I mean, what does LVMH
You're on top of it a little bit more than I am.
What does Louis Vuitton do and all that into the holiday season?
If you look at the stock price, we've wiped out the gains for the year in a lot of those places, Tom, including LVMH.
Yeah.
And a lot of that has to do with China and whether the Chinese buyers are going to come in, which brings us to the next thing that we're watching.
Thank
you. APEC summit taking place, headlined by China's Xi Jinping and Joe Biden. They're going to meet later this afternoon in New York time, 11 a.m., I believe, local time in San Francisco. You can expect all of the photography.
More handshakes like this one.
Yes, exactly. You can expect that. At 10:30 p.m.
Handshake.
Xi Jinping, that's
a photo op.
It's beautiful.
Is it one of those soft ones? I hate those soft ones.
Oh, no, the fist bump. We could do the fist bump.
No, but the soft bumps where it's like this.
Wonderful to see you.
Well, what if people have a problem with their hand?
Do you know what I see him do, Bramo, that I hate? TK does that left-hand thing.
Oh,
where he sticks out sort of like a wet left hand.
That's because because I'm over here and I'm shaking. John, wait till the first arthritis clicks in.
Wet left hand.
This wet left hand just sort of reaches out, and I have to apologise to him everywhere we go.
Really?
I'm sorry about him. I'm so sorry about him. It's like kiss the ring.
10:30 is the meeting that Xi Jinping has with this.
We moved past that, didn't we? I'm sorry. Sam Stovall's with us now, Chief Investment Strategist at CFRA. Sam, important question. I'm asking for a friend sitting next to me. What is your advice this morning to people who missed out on that rally just yesterday?
Well, advice, or more like just commentary, is my favorite financial philosopher, Charlie Brown, once said, I have a feeling that when my ship comes in, I'll be at the airport. So really just don't try to be at the airport or the shipping lines when you should be at the airport. A 9.3% compound annual total return going back over the last 35 years becomes 6.6% if you miss out on the 10 best days. Also, the fourth quarter pre-election year for first-term administrations has been positive 100% of the time with a total return of about 6%. We've already exceeded that. So essentially, yeah, there's still likely some upside potential in the second half of this fourth quarter, but much of the gains have already been made.
Sam, the night after the crash of '87, the Friday on Wall Street Week, Robert Kirby came from Capital Guardian Trust and American Funds in LA to New York to speak with John Templeton, Peter Lynch, and others about the end of the world as we know it. The Investment Company of America has delivered 11.84% per year since 1934. Tell our listeners how they can buy and hold constructively.
Well, I think, first off, just understanding stock market history can serve as virtual Valium. It can calm your nerves because you realize that while having declines is a very normal aspect of Wall Street activity, that the pullbacks, 5 to 10% declines, have recovered everything that they lost in an average of only a month and a half. Corrections, declines of 10 to 20% have taken only 4 months on average to get back to break even. So you're really better off buying than you are bailing. And also remember what Louis Rukeyser said on that Friday evening was that, your dog still loves you, your family still loves you. The market will do what it does.
I can't take this seriously. It's fantastic. Your dog will still love you. Your family will love you. Virtual Valium, better off buying than bailing. Sam, a lot of these beliefs, though, grew up at a time of an incredible bond rally that was driven by this idea of very low interest, very low inflation, and that really underpinned a lot of the equity returns. I understand over a long term, stocks have performed well. If rates don't go that much down further, how much does that affect the benchmark expectations for returns in stocks?
Well, you're absolutely correct that, in a sense, we've gone through two secular changes since World War II, where we've had a rise in interest rates from post-World War II till the middle of 1981, and then we've had a secular downtrend in long bond yields. So, yeah, you probably do have to split them up, and the double-digit gains that we saw in the secular downward move in interest rates are not likely to be repeated because they were significantly smaller when interest rates were rising. However, we're pretty close to what the long-term average rate is. The St. Louis Fed gives away free data, and the average since April of 1953 is 5.25%. So that's pretty close to where we peaked out in earlier October. So I would tend to say it's really more a question of corporate profit growth, valuations, et cetera.
Sam, can we talk about biggest risks now going into 2024? I'll give you one or two options. Do you think the biggest risk right now is that we get a material slowdown in the economy, or this kind of strength that we've seen so far in 2023 persists into 24? Which one is it?
Well, I think the biggest concern right now is probably the strength, because we've been calling for a recession for the last 2 years. And does the boy who cried wolf still get credit for the wolf finally arriving? So I think the real question is, we can look for retail sales today. The street is expecting a 2% decline. We think we might, or a 0.2% decline. We think we could see a 0.2% rise. So the consumer is still Well, for the next week, I think good news might be bad news, because the market typically declined in the 7 days after a small cap rise of 5% or more. However, we do tend to right ourselves 30 and 60 days after, up close to 6% for small caps.
What a game. Sam Stovall of CFRA. Thank you, sir. Retail sales about 80 minutes away. We'll see if good news is good news, or for that matter, if it's bad news, Bramo, a little bit later this morning.
Honestly, the key question is, what if it's not that great? We get good retail sales, but they're just like, you know, they're fine.
Lisa's back.
They're That's actually the best news that we could possibly get, right? Like mediocre news is the good news. That's my take.
That would cheer you up.
I think that would cheer a lot of people up because it wouldn't necessarily be inflationary, but it wouldn't be the retailers falling off a cliff. It would be, you know, a soft landing nirvana.
Like when you buy a Christmas tree, are you going for the fine, that's okay Christmas tree, or do you really want to support whole paycheck and, you know, get the 3-digit one?
I want the sad tree that no one else will get, but I will get and make it beautiful.
You're that person that chooses the runt of the litter, aren't you? When you go to buy a dog.
Yeah.
Okay.
There's no run of the litter with fake trees, is there?
You don't.
They're all perfect.
You pick
They're all perfect.
I pick winners, Bramo. That's what we do. If you're just joining us, welcome to the program. Stick around. Equity futures on the S&P positive here by 0.5%. Yields a little bit higher by a couple of basis points. 446.28, Tom. What a 24 hours in this market.
24 hours, and this is really the message this morning, even with the bond market with yields up 2 basis points after the festivities yesterday. John, I got a flat dollar. I have a bid on equities here. It's really important for people waking up here, radio and television, that 6 a.m., 7 a.m., what are we going to see at 8 a.m. in retail sales? There's a bid coming in. And I'm sorry, some of it is Target.
Well, there wasn't necessarily anything negative to cast any pall on what has acted as virtual Valium as people look out into the gains. What Sam said there, though, about the balance of risks, to answer your question, I thought was really interesting. The balance of risks, still strength. The more people keep worrying about recession, the more it prolongs it. It seems like that's sort of the case. And it's the moment that people start saying, you know, recession is off the table and, you know, lean into risk, do we start to see that shift?
Yeah, he said the boy who cried wolf, and I think all year we've said the economist who cried recession. It's kind of been the story of 2023. Equities are higher by 0.5%. TK mentioned Target. That stock is up by 15.3% in the pre-market. Henry Trays of Vader Partners is going to join us in DC up next. It's Fight Club Mark II in Washington. Tom, more still to come. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer today on Bloomberg.
When it comes to government funding, as I have long said, it has to be bipartisan. And right now, that's the path we seem to be on.
We are not going to have a massive omnibus spending bill right before Christmas. That is a gift to the American people because that is no way to legislate. We've gotten together. I believe there's going to be bipartisan agreement on that to break it up.
Some rare good news in Washington, D.C. That was Senate Majority Leader Chuck Schumer, House Speaker Mike Johnson speaking just hours before a bipartisan vote in the House passing a stopgap funding bill that would avoid a potential government shutdown. That bill now moves to the Senate, and TK, we can move on, at least for about a month.
Well, that's what they say, but it's a month into January, right? I mean, to cut to the chase, we're doing this again after the first of the year.
Yeah, once and then twice. It's going to be fun.
Twice even. I don't know. I don't think it's healthy. I don't think it's good. I'm going to go to Robert Hormats in his great book on you got to have a sound fiscal house to prosecute domestic and foreign policy. I would suggest right now, particularly with the violence we saw yesterday, that or threatened violence.
Well, the threats of violence. Is,
threats of violence.
A more accurate way of putting it. Yeah.
It's maybe too much. I mean, Hugh Morris in the Telegraph, this from a number of years ago, the 7 secrets of the Houses of Parliament, which you won't learn on its new virtual tour. We're thrilled. I mean, John, this is important here as we go to Henrietta. This is a tweet. Ian, thank you so much for efforting this bit of Pharaoh history to us. And it's real simple. I mean, there it is. Violence in the United Kingdom Parliament. There are lines in front of each bench in the House of Commons still. MPs, what's MPs?
Members of Parliament.
Members of Parliament, thank you. Must stay behind them, toe the line, and let's stay at least a sword length away from the opposite MPs. And they're serious.
I didn't know that, Tom. I don't know if you fact-checked that, but I did a little research myself in a commercial break. I'm told the Sergeant of Arms
has a sword,
is the only one allowed a sword.
Yeah, it's like the one in the beginning of Game of Thrones.
Ceremonial stuff, yeah, just like that.
Just like
very
that
accurate
one.
Game of Thrones.
But it's a sad state. I mean, to be honest with the video we showed in the last hour, for those of you on radio, the video is more shocking than the language. I mean, to me, it is a new threat, a new violence.
Is that what you think?
Yeah,
I think we're going to see more of this kind of thing down in Washington.
Yeah, well, there's always stupid stuff going on in Washington, but this is a new...
This reminds me of just, high school TikTok videos that people send around to try to look cool.
Yeah, but it's Congress.
Exactly.
Exactly. Expert on this, and she's good with a sword. Henrietta Trace joins us now. Economic Policy Research Director at Veda Partners. Henrietta, with all your years of experience in Washington, how polarized is the polarity right now?
I mean, they are just at each other's throats, almost literally. Certainly, the stories out of D.C. yesterday were just shocking. Frankly, they have to go on recess. I am so thankful that they have agreed to this kick the can approach. As you mentioned before, I think we're just going to be doing this again. And I'm not optimistic that it's going to stop in January or in February when the 2 current deadlines exist. We're going to be doing this every couple of months for the rest of 2024. So we should get used to this kind of acrimony, government shutdown risks. Those headlines should just be permanently emblazoned every couple of months in the newsreel.
We've got those headlines ready to go. Henrietta, through the whole of 2024. Can you just frame how big this fight over spending might be just next year?
It's just loud. It's not a big fight. It's just a loud fight. They are not getting any reductions in federal spending. This is a clean CR. There will be a minimum of about $100 billion in additional aid that goes out across domestic and international priorities. We are not fighting about spending cuts. We are fighting about the process. The Freedom Caucus came up with the idea of doing this laddered approach. It was rejected, resuscitated, and then finally included in part in this deal, but it contains no spending cuts. And there's no scenario where the second tranche, which includes defense and foreign operations spending, is going to expire after they reach a deal on the first couple of appropriations bills. So this is a lot of sound, this is a lot of bark, very little bite.
Given the fact that there was not Israel or Ukraine funding in this current bill, how likely do you think that will get done by January, by February? Does it even matter considering the spending that's coming out of different pockets?
That's a really important question, and I think a lot of this is tied up with Minority Leader McConnell and how much clout he continues to have with the party. I think we can't underestimate the impact of the loss in Kentucky for the governor's race. That materially impacted his standing with his own conference in the Senate Republican caucus. And I think that's a big problem for Ukraine aid. I was surprised in my last round of meetings in D.C. how little support there is for Ukraine versus what there has been from the United States for the last year and 8 months. It is really a iffy question on whether Ukraine aid gets provided at all. I do think that keeping Israel aid off of the CR that they're passing now creates at least a pathway. But when you tie Ukraine to the border, and recognize that we haven't had border security legislation pass in a decade or more, you really have a problem. So I think that it is good news that we don't have a bill yet. It keeps hope alive. But I would dim my expectations for robust aid to Ukraine. And Israel, obviously, is another problem that is splitting the Democratic Party just in half, just ripping it apart. So those packages are going to be really hard to come by, and I wouldn't be surprised if they didn't get it till January.
You know, it's getting harder and harder to parse through the signal from the noise in Washington, D.C. We have all these real, tangible, important issues, and yet we are focusing on scuffles, both in the Senate that Bernie Sanders had to end with a wooden gavel, and then the accusation that Kevin McCarthy elbowed fellow Republican Congressmember Tim Burchett during some of the contentious negotiations. Are any of these important to you on a policy or just functional level?
There is no policy. So I think when you, Tom, you actually just made a statement about how if you don't have your fiscal house in order, you can't enact policy. That's exactly what's happening. There is no policy, so we're only talking about fiscal austerity. There's no discussion about passing a year-end tax bill that's of any kind of merit. They're running around punching each other in the back because they have gripes and qualms with who's a liar, who has trustworthiness. There is no policy. There's no uniting policy that drives the House Republican Conference, which is in control, and that means that the Senate can't get their act together or get their work done. And it's really been a dearth of leadership that I think is exacerbated by Mitch McConnell being on the way out and a speaker that is untested with no real leadership mandate to work with on the Republican side. So I think there is no policy. I don't think we will be voting on any meaningful legislation next year. They cannot move forward on impeachment. They can't move forward on impeaching even the Homeland Security Secretary. They don't have a plan for the border that is comprehensive or can pass with the Republican conference. When you have these tight majorities and a lack of leadership, this is where you land. So we just have these short-term fights about federal spending. Thankfully, we don't have to deal with the debt ceiling next year. That would have been a real problem.
Well, Henrietta, given everything you've just said, doesn't that make it all the more amazing that we managed to find an agreement in the House yesterday?
I mean, yes, and I don't want to be just contrarian, but the scenario where we shut down is even worse because there's no path to reopen. So if you shut down the government, we will be shut down for quite some time. People talk about, oh, we couldn't possibly go past 2 weeks because you'd miss a pay cycle. The last time we did this for no good reason with no end in sight, we shut down for 35 days right over the Christmas holidays. I think the one thing that's kept my optimism alive, contrary to a lot of popular opinion, with 20% or less odds that we'd shut down all year, is basically that the alternative is worse. Shutting down means we stay shut down for quite some time. Everybody looks incompetent, and you can't have these fights about fiscal austerity and spending if you're shut down. It starts to have a material negative impact. So, they're both bad options, but shutting down is the worst one.
Well, lots of them look incompetent when it's open. Henrietta Trey's there of Vader Partners. Henrietta, thank you. TK, Dan Tannenbaum writes in, sanctions expert. I hear they're bringing the jewel back to settle disputes in 2024. It's the last 24 hours has been nuts.
Jim Shanos' national, the museum over in Central Park West, the historic New York Historical Museum, has sculptures of Burr and Hamilton, like life-size, like how far apart they were. The pistols are huge, and it's frightening. I mean, I was scared stiff when I saw it. Made me jump.
Pistols.
Yeah, made me
Instead,
jump.
they're running around punching each other in the back, as Henrietta Trey's was saying. But at a certain point, how do you move forward if basically what she's saying is this masks the fact they've got no policy? It creates a real issue.
Yeah. As an aside, with China coming to San Francisco, there is a sea change overnight. Our Erica Yokoyama in Tokyo, John, reports a brilliant story on the collapse of the Japanese economic experiment. Nominal GDP on the Japan malaise, under 1%. Shock inflation reports, shock real GDP there. Torsten Slot cuts to it simple. 10% of Japan's over 80 years old.
That's quite a stat, isn't
That's
it? Yeah.
a stunning stat.
Coming up next, we'll talk about the bond markets. Arbitrage of SocGen, that conversation just around the corner. Equities positive here by 0.4% on the S&P from New York City. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The rally continues on the S&P 500. Here's the shape of things right now. Stocks are up on the S&P, on the Nasdaq, the Russell. On the Russell, the small caps up in a monster way in the last 24 hours, up by 0.6% on Russell 2000 futures. Yesterday, small caps up by 5.4%. Best day of gains in about 12 months on a Russell. On the S&P 500, best day of gains since April. Within the S&P 500, every sector in the green, real estate, top of the pile. Best day this year, helped out by the bond market. Check it out. 2-year, 10-year, 30-year. 10-year right now, sub 450, 447. Yields are higher this morning, but aggressively lower in yesterday's session. 2-year out to 30-year. The yield leads to drop in by double digits in the last 24 hours.
So I think that what we need to do over the next couple of months is parse through the distinction of, okay, the Fed may be done, but how much are they actually going to drop rates? And we've been talking about that all morning. There's a big distinction between kumbaya, hallelujah, wow, we're going back to low rates, versus we're going to stay here and see what happens, especially given the long and variable lags.
I go back to the physics of it, maybe the Newtonian calculus. To me, it's a vector play. It's not about getting to a given point, or, as Jim Bianco would say, leveling out here, which is a real tangible probability and outcome as well. It's just the vector confidence went through the moon today.
This is what we've been talking about, Tom. Yeah. What's the bet right now? Is the bet that the fight against inflation is over, one, or is it two? It's over, and it means the Federal Reserve can aggressively start cutting interest rates. They're two very different stories going into next year.
Well, we need more data, and I'm sorry, we haven't made enough of a deal about it, folks, because I'm in shock over the equity markets yesterday. In 29 minutes, John, retail sales, and I'm sorry, it was important yesterday. It's ever more important now after the celebration that we saw yesterday.
That data point about an hour away, we've had a sneak peek of some of the numbers from some of the retailers in America. Target this morning, up in a major way in the pre-market, it's higher by more than 15%. We just heard from TJX. At least the numbers from them at first look pretty decent as well. $1.03 on EPS. Looking at some of the numbers elsewhere, raising full-year guidance for comp store sales and earnings too.
Yeah, talking about full-year earnings per share of $3.71 to $3.74 versus the expectation of up to $3.72, just coming off a touch because it didn't beat necessarily all that much. But to me, it really highlights how companies are still seeing inline operations, even despite all of the optimism baked in. Again, I want to hear the commentary. The commentary might be more interesting for some of these companies based on what they're seeing going forward. And which consumers are coming to them? Is it people looking for bargains?
There's always been this huge respect for TJX. And to go to the net income margin that I mentioned earlier, Home Depot, 9 cents maybe on the dollars, what they take down to the bottom line. Target, really a different paltry view of 3, even 4 cents on the dollar. TJX is very Home Depot-like. I mean, the profitability, 8 cents on the dollar is pretty darn good.
Numbers at first look decent. In the pre-market, the stock is totally unchanged. More on that name a little bit later. Under surveillance this morning, Israeli troops entering Gaza's Shifa hospital compound. As military operations intensify, Israel saying the move is part of a, quote, precise and targeted operation against Hamas. Israel also adding it's bringing supplies into the facility, Elisa, which houses hundreds of patients, medical personnel, and displaced civilians. U.S. intelligence confirming Israel's view that Hamas uses the hospital to conceal and support its operations. This is a big, big focus in the last day or so.
It's a massive focus because the idea of a hospital at the center of a war is absolutely offensive to everybody. Who to blame? You can go and play the blame game all around the table. There is a key question, though. How much more time does the Israeli army have before they cannot continue with the support that they have from Western leaders? You hear President Biden getting louder in his frustration about the civilian deaths. There feels like in 2 to 3 weeks, there will be some sort of conclusion in some sort of capacity.
So who's going to police them? Which outside force is going to tell IDF what to do? I mean, that's what I don't get. I get the diplomacy, and I get the goodwill of it and all that. But this is absolutely original because of the immediacy of media. The immediacy here of this hospital with tangible images. There has never been a war like this before.
This military conflict, I have no doubt, is going to be part of the conversation with Xi and Biden a little bit later. Not just this one, but also the one in Ukraine. That meeting, one to watch a little bit later on this afternoon. Elsewhere, the tentative agreement between GM and the UAW at risk of failure as two big plants voted the deal down. 16,000 workers have voted so far, with just 52% of them approving the contract, according to the UAW. Lisa, the close margin setting up key ballots at plants in Fort Wayne, Indiana, and Arlington, Texas. The voting deadline, 4 p.m. Thursday. Union workers for Stellantis and Ford have shown more support so far.
GM seems like it's had a perpetual issue with the UAW and much more sort of intractable conflict in terms of getting to some agreement. Not really in the headlines, the buyouts that Stellantis and Ford and even GM have been doing, which to me is interesting. They're trying to cut costs where they can. They're going after non-union workers who've been there for 5 years or more. But to me, what this highlights is how much is this a last gasp before some serious changes come to some of the plants that are struggling in the face of new competition and new products.
Shift to EV. It's going to be so difficult. I think we're all witnessing that in the last few months. Final story for you. Citadel founder Ken Griffin saying he'll decide soon about financially backing GOP presidential candidate Nikki Haley. Griffin caught up with Bloomberg's Sonali Basak in Miami.
Are you supporting her financially yet?
That's a decision that we're actively contemplating. I mean, we're at the finish line on that choice, yes or no. But I think the real issue is Donald Trump, for all of his bluster, willing to get on stage with Nikki Haley or not?
Ken Griffin of Citadel. TK, quite a day for Nikki Haley in terms of some of the big names in finance. Jamie Dimon, according to Axios, has been privately talking with Haley about the economy, suggested to be impressed by what she had to say. And now you've got Ken Griffin with a lot of financial backing, Tom, to distribute going into that campaign next year.
The confusion here is the former president is associated with his tower on Fifth Avenue, right next to the Gucci kids store. And he's he's supposed to be a New York City guy. And the reality is his fortress is in Florida, and that's where his foundation is. And these guys are searching for somebody that can represent business interests.
The primaries are going to be really interesting, especially in New Hampshire, especially in Iowa, because if Nikki Haley gains traction, expect some of these people to really throw their weight behind her.
You've seen some of the numbers, Tom, that Ken Griffin's been putting into politics? Some big numbers, you know.
Oh, yeah. I mean,
I think there were some people who thought that a lot of this financial backing would go to the governor of Florida, Ron DeSantis, and now we're having this conversation about Nikki Haley. That's a change in momentum that we've been talking about.
Oh, yeah, it's a change, but get the calendar out.
Weeks.
It's November, and it heats up. I'll leave it up to Anne-Marie Horton to tell us, but I'm sorry, it heats up February, which is almost on top of us. It's like 2 months away.
Got the number for you.
2.5 months
Contributed away. Almost $72.7 million during the 2022 midterm election cycle.
Maybe
based on our reporting,
Maybe he'll buy the New York Yankees. Joining us now on where we are after yesterday, a readjustment is in order. Subhadra Rajappa joins us now, head of U.S. rate strategy at Societe Generale. What did you adjust yesterday, Subhadra, in the area of 8:30 or through the day in your meetings at SocGen? How do you adapt and adjust to what we observed?
We didn't have to do much in our forecast because this is kind of what we were expecting, is a gradual moderation in inflation and for yields to gradually decline towards the end of the year and even beyond that. So this is very much playing into our narrative. It's really hard to know exactly which month shelter costs are going to moderate. We thought it might have been last month. It turned out to be this month. But the trajectory over the longer run is that inflation should start to gradually decline over the coming months.
Decline to what, Subhadra? This is sort of the key question at a time where a lot of people are pricing in significant rate cuts by the end of next year.
Yeah, no, core PCE maybe in and around 3.5% by the end of this year, and by 2.5% by the middle of next year. So the trajectory is for a very gradual decline between now and the middle of next year. But that should be sufficient for the Fed to adjust policy if they need to, but given the fact that they've raised rates so aggressively in a very short amount of time. I think if they even cut rates a little bit, that's going to provide the support the market needs if there's a meaningful slowdown in the economy.
I think that the contrast between the slow, steady way that people talk about longer-term economic outlooks and the whipsaw, violent reactions that we've seen in Treasury yields is sort of an interesting divergence. What do you make of the fact that the economic outlook hasn't changed that dramatically from one month to another, and yet we see a 50 basis point swing in benchmark Treasury rates? What does that tell you?
It tells you that the market is paying attention to every word that's coming out of the Fed. After the FOMC meeting, Powell sounded a little bit dovish, which is not really the market's expectations. We saw this really sizable rally in Treasuries. He then tried to walk that back in his speech on Thursday, which supported modestly higher yields. But you're also talking about an environment where liquidity in the bond market is extraordinarily choppy. And then add to that, risks associated with cyber attacks, and you see all of these very volatile moves in the bond market on the back of that. But I think we have to kind of take the signal from the noise, and the signal there is that the Fed is going to keep policy on hold, and yields should gradually decline over the next 6 to 8 months.
What will the inflation-adjusted yield do? I've got a real yield print this morning of 2.20. It was 2.16 in the enthusiasm yesterday, coming down, down, down. Does it drive down further through 2%?
Yeah, I mean, the real yield has declined quite dramatically as well. I mean, when real yields got up to around 2.5% in 10-year real yields, we kind of attributed that to the rise in term premium, more supply, the Treasury having to issue more coupon debt. And you know what? That scenario hasn't really changed meaningfully. And yet term premium has come down, and real yields have come down as well. And I think that that's more the market trying to assess where yields should be from a fundamental basis. And given the trajectory for growth as well as inflation, yields should be gradually moving lower.
Subhadra, this big conversation now sparked really by yesterday's inflation print about rate cuts next year. Can we just sit on QT for a moment? What's your outlook for winding down the bond buying program at the Federal Reserve, pulling back on that balance sheet?
Yeah, I mean, I think that the Fed definitely wants to continue QT for as long as they possibly can. So to me, the debate is, will they continue QT when they're ready to cut rates? I mean, the market's pricing in for the Fed to cut rates as early as May. I mean, May meeting is fully priced in, which was kind of our economists' call for the timing of the Fed cuts. The question is, beyond that, do they continue QT? And I think our feeling is that they will continue QT in the background for as long as they can, which could be as late as the third quarter of next year. Then they might think about tapering or slowing down the balance sheet runoff, depending on how the economy does and how much they're going to have to cut rates. Because in some respects, cutting rates and doing QT are opposite, effects. So, we'll have to see how that plays out. But our call is that they're going to go on with QT at least till the third quarter of next year.
I'm really intrigued by the sequence of events as well around that. I know why they don't want to entertain it currently, but something to look out for maybe next year. Subhadra, thank you. Subhadra Japa there of SocGen. If you're just joining the program, welcome. Your equity market on the S&P 500 is just about positive here, up nicely again by 0.4%. Yields climbing a little bit higher by 3 basis points, 448.24. 1.04 on a 10-year, just a monster turnaround in the last 24 hours. Yields aggressively lower yesterday. I want to sit on foreign exchange. The euro this morning, 108.55. We're pulling back some euro weakness. Yesterday, the dollar weakness, yesterday was the worst day for the dollar for the whole of 2023, Tom. 12 months. The last 12 months, been that bad?
It was there. I really looked at every single pair I got on the screen. I probably got 25 pair on the screen. And what was interesting, some things really moved and some things didn't. And it was interesting to see the euro move out to a 109. And also yen moved. I look at euro yen 163. But what was interesting off the grim GDP report that we reported out of Tokyo, I mentioned that earlier, the yen really didn't move all that much. I think Japan, I can't emphasize enough the shock within their system to what we saw, and yen didn't move.
Dollar yen right now, basically unchanged, TK. Yeah. Dollar yen at 150.47. Coming up a little bit later this morning, next hour, 8:30 Eastern Time, US retail sales is the next big data print of the week so far from New York City. This is Bloomberg.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg.
The numbers have not been great. 0, 0.1, minus 0.1 quarter on quarter for 5 quarters in a row creates a little bit of anxiety over will this be a soft landing? This stagnation of the euro area is, of course, a source of concern for all. It will help bringing inflation down, that's for sure.
ECB Governing Council member and Bank of Portugal Governor Maria Centeno there, speaking with our own Anna Edwards and Tom McKenzie a little bit earlier. Look at the scores right now in the FX market. The euro at about 108. Yesterday, that currency pair, the highest since late August, Tom. 108.54 on the euro right now, putting back by 0.2%.
We are focused on the markets. There's no other way to put it. And of course, retail sales coming up here in less than 45 minutes. It's been an American discussion of the markets, and we've a bit taken our radar off of greater Europe. There's one note, just a few people, John, is qualified. There's Paolo Gentiloni. He's, yes, EU Commissioner for Economy, but John, he has lived the challenges of Italy. And we're thrilled that the Commissioner could join us this morning. Paolo, I'm absolutely taken by the stridency of President Lagarde of the ECB to get back to the comfort of a 2% ECB statistic, a 2% interest rate. What is the probability of doing that any time in the near future?
Well, good morning. According to our estimates that we presented this morning, we will be very near to this target in 2025, meaning that the pace of decline of inflation, which was very sharp October 22, October 23, will be a little bit slower in the coming year and a half. But we expect this decline to go towards 2% by the end of 25.
I look at the jumble and, of course, the celebration in America of successfully getting in trend disinflation, getting the vector moving in the right direction. John Farrell, my colleague, mentions the United Kingdom with a better disinflationary statistic. Can you say, not mission accomplished, but can you say you're going to see the same headlines in Europe soon?
Well, if we look to the last figures that we have in inflation, these figures were on October, and the inflation rate was 2.9%. If you compare this October to October 2022, they were at 10.6. From 10.6 to 2.9 is really a sharp decline. But having said this, we know that this was mostly determined by decrease in energy prices, and that so it was very much determined from the hikes in energy prices autumn 2022. This means that the path that we have ahead of us will be more gradual, but indeed I think that we are on track for this sharp reduction, provided we don't have surprises on energy prices connected to geopolitical evolution, which is our main concern.
Commissioner, can we talk about Italy specifically? You've got the deficit in Italy coming down to 4.3%, I believe, in 2025. That's different to the government. The government has a projection of 3.6%. Can we just start with what underpins that different projection from your side?
Well, we have different calculations. For example, we estimate in our forecast expenditure to reduce the labor tax burden that the Italian government has taken last year and this year and not factor in their forecast, but they announced that they will keep this measure, and so we have this factored in our forecast. So the difference is not enormous. One of the main factors is that we calculate this tax labor reduction, and they are not yet calculating it.
You have it materially above 3%, though, in 2 years. Can you help us understand, Commissioner, what happens if that number comes in line with your expectations? What happens?
Well, you know, we have fiscal rules, and we are discussing how to update them and to make them more efficient. But something that, in any case, will not change in the coming fiscal rules is the fact that we have a threshold for deficit, budget deficit at 3%. So we call to each government to reduce their budget deficit. Of course, we know these budget deficits are coming from the double shock that we experienced in Europe. First, of course, the pandemic, and second, and this was different from other regions of the world, the energy shock that we experienced last year. So we know where these high deficits are coming from, but we want to bring them down. And honestly, on average, we are bringing them down. The reduction of the debt at European level, 23 in relation to 22 was substantial.
I have to say, you sound sympathetic towards Italy's predicament. Commissioner, would you be advocating for a commission that was more accommodating of bigger deficits?
No, I think it's serious to have a reasonable threshold, 3%. By the way, in my own country, I had the opportunity to participate to 3 different governments and to lead one of them. We were always in the last 15, 20 years, apart from the COVID crisis, with a primary advance and below this 3% threshold. So I think the threshold is reasonable, is a common rule, and we need to go back to this threshold, of course, taking into account the extraordinary situation we lived in the last couple of years.
I want to finish up where we began, which is your new projections for economic growth, which were downgraded. And I'm wondering how wide the potential range of options are for your forecast if there is another cold winter, for example, if there is some sort of energy shock, or on the other hand, if we continue to see oil prices where they are.
Well, I think we are better prepared than in the previous autumn. Previous autumn, we were indeed starting an uncharted world. We didn't know how. We had to cut the Russian gas, and we were uncertain on supply of energy. Someone was predicting blackouts, recession, etc. We didn't have blackouts. We have a level of storage of gas which is the highest in the last 10 years. And I think we reduced energy consumption. So we are better prepared than last year. Prices are much, much lower than last year, but they are still high in relation to the pre-war in Ukraine. So we had to address a difficult situation, but I have to say it's not so difficult as it was 1 year ago.
Commissioner, thank you for the update. We appreciate it as always. Paolo Gentiloni there, the EU Commissioner for the Economy. You have to think back 12 months. Going into last winter, Lisa, there was this real fear that Europe was going into a dark, dark place.
Yeah.
And quite literally as well, given the energy situation. Didn't materialize. Didn't materialize.
And now it's not really even in the outlooks that much. It's not the sort of fear hanging over everything. Have we really solved the supply chains with respect to natural gas, depending more on Qatar for some of the shipments to Europe? These are some of the questions I don't know if we've fully answered yet, given just how much of a question it was last year.
I'm going to suggest, as an amateur, that it links into retail sales here in 35 minutes and then try to get a plane seat to Milan. I mean,
it's
seriously,
expensive.
Try to get a
Tickets
plane
are going
seat to
down.
Milan.
Prices are going down.
Okay, they're going down maybe for the first time, but I'm sorry. You know, Mr. Gentiloni's Italy is in a boom economy, and yet at the same time, there's this massive migrant debate.
I use my air miles, TK, to get to Milan.
I use my air miles to move children around. They're good at moving children around.
You use it to upgrade. Is that what you do?
Yeah.
Oh, nice, Lisa.
Vet bill's going to
Bramo
Vegas.
in business.
Hey? Ramo's large.
Occasionally.
Living it up, Lisa. There we go. Lisa's really spending. This is a turn. This is
She'll take the refrigerator with her.
A refrigerator.
No, hold on a second. I don't pay for it.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close
A lot of this was priced into the U.S. session.
to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
On the next episode of the Business Week Show.
Reputation. People say, oh, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation. That can be a positive step.
Watch the Business Week Show Thursday nights, 10:30 Eastern on Bloomberg Television or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
If you get another solid retail spending print, I think that's net positive for equities.
The American consumer does have the propensity to spend in the fourth quarter and into the holiday season.
If we lose the labor market, we lose consumers. If we lose consumers, we're done.
We just think that it's a market where you have to be nimble, you have to be reactive.
We don't think that we're in for a boom time in 2024, but we do think that the resilience we've seen can hang on.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Retail sales here in 30 minutes. Will it be the same festivities as we saw yesterday? John, it continues this morning. Pre-retail sales up 0.7% on the NASDAQ 100.
It's just been a phenomenal move on the S&P 500. Best day of gains since April across the board. You saw gain after gain. TK across the board. Every single sector in the green in yesterday's session. Small caps up more than 5%. Best day of the year. We talked about real estate on the S&P. Best day of the year. I hate to spoil the party, but this from Andrew Honhorst over at Citi. The reading does not change our view that underlying inflation is likely to remain stuck above 3%. In fact, he goes on to say the risks of sustained higher inflation rise with the reloosening of financial conditions. That last line on the reloosening of financial conditions. This is why I think a lot of people, Tom, inclined to say this market is declaring victory. The Federal Reserve will not. Because if they do, what do you do?
We're going to rip up the script right now. The Bramo cam is on fire. Lisa, please comment on the idea of, as Jim Bianco and Dr. Hollenhorst suggest, a leveling here instead of the nirvana of to 2%.
It's how it happens, right? Is it a matter of the Fed having to do more to bring inflation down to that 2%? Or is this just, benchmark rate staying around 4% for a full year? it's a difference, right? The inflation versus the benchmark rates, and whether the Fed actually has to surprise with additional rate hikes. Right now, that's off the table. And I would imagine that the narrative shift would cause rather a shock in market pricing.
We're in data dependent in 28 minutes. Our team has really worked on equity perspective here. Yesterday was outstanding. Sam Stovall, truly a legend, and his family here. And we've got another winner on the bull market, Anastasia Amoroso, in a moment. John, everybody this weekend. I mean, come on, it's Wednesday, but we're rewriting for the weekend.
You're already
right
at the
now.
weekend. Things are that good.
Strategists are at the weekend. They're ripping up their outlooks and they're ripping up their allocations, if you will, to get to next week.
David Costin and Goldman just published, looking for 4,700 on the S&P 500. At least a year end next year. Based on a move yesterday, we might get there this year.
Exactly. So at what point do you say, okay, we're baking in gains that are going to be had next year? And at what point are we saying maybe we're underestimating yet again the strength that we're going to see not only in the economy next year, but also in markets?
I want to get to the data check. The guest is so important because she nailed this bull market. John, I'm looking at the drawdown here, taking some of the details of the futures market with the S&P up 20 points. SPX from the, 18 months, 19 months ago, -6, down -5. But the NASDAQ has really come on. It was double-digit drawdown, now only -4%.
Big moves yesterday. We had some weight to this rally this morning. We're up by 0.5% on the S&P 500. Futures shifting higher. In yesterday's session, yields aggressively lower. 2-year out to 30-year this morning. Just a little bit higher, up by 2 basis points, but still sub 450 on a 10-year. 447.26. Lots of dollar weakness out there just yesterday. Bit of dollar strength against the weaker euro this morning at 108.65. That currency pair near the highs of late August after the worst day, Tom, of the year for the US dollar.
The grace of Bloomberg surveillance is we don't throw up films of people being wrong or people being right. This is a tough, tough business, gaming out equities, bonds, currencies, commodities. If we tossed up a video, John and Lisa, of Anastasia Amoroso on the market a number of months ago, she held Lisa's hand and said, "Lisa, it'll be okay." The chief investment strategist
it wasn't cold and wet.
and correct bull joins us now. Is this the second bull market off the October lows 13 months ago? Are we clicking in with a new bull market lift?
I mean, I think this is giving investors a lot of faith and hope into the year end. You know, Tom, it's amazing how quickly things shift. And just in the last couple of weeks, we went from really bad technicals to really a great technical setup. And I think what's likely to happen now is the chase into year end is on. And it's going to involve a lot of stakeholders, whether it's the systematic traders, whether hedge funds that were caught too short, whether it's all the cash, $8 trillion of it on the sidelines. So I do think that I was initially going to say drift higher into year end. Based on yesterday, we might rip higher into year end, but I do think we finish higher.
Let's discuss what worked yesterday. Small caps, discretionary, real estate. Is that what you think works going into year end?
Well, I think tech is going to continue to work into year end because if you look at unprofitable tech, for example, it also rallied pretty massively yesterday as well. You know, the reason I hesitate when it comes to consumer discretionary, you know, I love the target beat this morning, but it does feel like a bit of a one-off. And, you know, if we look at some of the surveys of consumer spending intentions, consumers are likely to be slower and likely to be more discerning, and they're going to want to look for promotions. So, you know, maybe this everything rally does take consumer discretionary higher with it, but from a quality perspective and where I have the most convictions on margins, on growth, on secular opportunity, John, I think it's still tech.
Okay, so how much is this baking in both the ongoing profits and also yields going lower, given that valuations are already pretty high, considering how high the alternative is?
Yeah, I mean, everything is working in the right direction right now. Clearly, this is a huge yield story. But when it comes to big tech, for example, you know, yes, yields help from the valuation perspective. But what I also like about big tech, for example, is that earnings growth is there over and above the S&P. For example, for the next year or two, the average earnings growth is about 16%. So, and by the way, valuations, I know people say big tech or tech generally is expensive, but when you adjust for that earnings growth, it's actually not that expensive. And when you start looking at individual stocks, maybe 40 times forward earnings on NVIDIA, maybe that seems expensive, but when you expand the chart, it's not actually off the charts, so to speak. So everything is relative.
What's the balance of risks? We've been talking about that throughout the morning for next year. As people get enthusiastic into year end, is it a better than expected economic picture, or is it some sort of recession? that really feeds into a profit recession as well.
Yeah, so we have to decouple the view into year-end versus what might happen in 2024. And I think the reason for this optimism for 2023 has been this is a soft landing year. This has proven to be a soft landing year. Now, I think something harder may have to happen in 2024. And here's really the big question, which is going to determine the direction of the markets in 2024, is how quickly does the Fed cut, or do they cut? If they cut, then I think we're off to the races, and this is the go in all on risk moment. But if they don't cut, if they stay persistent, then I think some of the bulls may be disappointed.
Do we underestimate the ability of corporations to adjust? 24 months ago, I was screaming about that. We saw Target today. They've had a real post-pandemic challenge. I guess, John, what's it up right now? 42%?
It's up 13.25%.
Okay, 13%. Who's keeping count? But the answer is, I still think it's underestimated in Fed-centric, rate-centric New York City that, I'm sorry, each and every corporation out there is going to adapt and adjust. What are they going to do next year?
Yes, corporations are adjusting, and in the case of Target, it took them a while, but those inventories were eventually pared back. I think what corporations may struggle with next year until and unless the Fed pivots is the refinancing bill of some of their corporate debt. And by the way, this goes across the spectrum. It's the U.S. government, which has to refinance about 35% of the debt between now and the end of next year. It's the commercial real estate operators that have to refi a lot of the debt, and then it's corporates. So, the reason, Tom, why I think we haven't seen more of an adverse impact is because the percentage of floating rate has been low, and companies have not had a lot of fixed rate maturities that needed to be refinanced. That does start to change next year. So if the Fed doesn't cut, I think it does become harder for corporates. And how do they adjust? Well, if margins get squeezed, I think cost cutting is the next measure.
Does that make life difficult for certain parts of the equity market, given the nature of high yield issuers?
Yeah, it does. The parts of the market that I worry about are leverage loans, for example, which have already had a full year of rates around 5%. And if you look at the net interest coverage ratios, they were about 3.5 times going into the year. For a lot of those issuers, they're one times today, maybe 1.3. So how does that picture change next year, especially if you have some slowdown in the top line? For high yield, I'm a little bit less worried because you do have generally higher quality and better fundamentals. And there's a small portion of high yield that needs to be rolled over next year. But from a broader economic perspective, and especially when I think about the banking sector, if you start to have more charge-offs, incrementally more delinquencies, some defaults, and by the way, venture capital bankruptcies have been on the rise. So all of that does start to impact some sector of the economy, which I think is the bank.
Can we finish on the banks? Kind of left for dead at times this year, and for good reason earlier in spring. What's your view on them into 24?
Very mixed view on them into 2024, because earlier on the show I did say that, I was kind of warming up to the bank sector because we were expecting the capital market activity to pick up. That really didn't pan out so far in the fall of this year, and I'm not sure that it does in 2024. So if you have lackluster capital market activity in 2024, and then on top of that, you do have those higher delinquencies, defaults, and charge-offs, that comes back to roots for the banking sector. So I appreciate the rally that they're participating in, but that would not be my top pick today.
You sound actually less optimistic than you did a bunch of months ago, quite a bit less optimistic. Can you frame that out, just how much you think some of the gains have already been baked in?
Yeah, I definitely sound less optimistic, year-end rally notwithstanding. And the reason for that is because a lot of investors coming into the year expected this to be maybe even a recessionary year, or at least very lackluster economic growth. And instead, we got close to 5% GDP in the third quarter. So a lot of people are now in the soft landing camp and are not even talking about recession. But if you think about this, the longer rates stay at the current levels, and by the way, if inflation falls and real rates start to pick up, the relationship we also talked about previously, then we are going to get in restrictive territory relative to the neutral rate. And that's when you start to worry about if the Fed stays there for too long, then that's what caused historically a recession. So I do worry about that, and I don't think it's in people's consensus numbers right now.
Is my takeaway here that Amoroso is on the edge of Bramo?
Open to a year-end rally, but maybe less constructive going into 24 seems to be
But
the view.
it's going to be a long year of 24, so we can't just, prepare for the whole thing today.
Where's the joy that I heard 6 months ago?
Oh, the joy is here. The joy is into year-end, and I do think look, the Fed for now seems to be behind us until mid-December. I think some of the worst Treasury auctions are behind us as well.
There we go. The auctions, okay.
So that's the joy.
The conversation begins.
The joy was on the screen over the last 24 hours in a major way. Anastasia, constructive so many times this year and right to be. Anastasia Amoroso of iCapital. If you are just joining us, catching up with us, your equity market's still positive, up by 0.4%. We are about 18 minutes away from US retail sales, the next big data point of the week following CPI yesterday. Amazing to see. Just a really small downside surprise on CPI, triggering a massive move in equities and bonds. Just the very definition of an everything rally. Equities rallying, bonds rallying too, yields dropping aggressively. That was yesterday. Lisa, this morning, yields up 2 basis points, a 10-year just short of 447.
And the why behind this, right? It wasn't that big of a miss or sort of a downside, right? This idea that something of a softening was a good news moment. It was that this was a market looking for some narrative, and it found one, and it could coalesce more concretely around this soft landing kind of feel. And that, I think, is what generated this incredible rally.
I think the business plan at Target today, and, granted, we're going to see the world's going to change here in 16 minutes, but the bottom line is corporations are adjusting, cutting expenses, last in, first out, and all the rest of it, John. The real nuts and bolts of business corporations are executing.
Certain days where you walk away from the price action of, say, a day like yesterday, where I spend more time thinking about the reaction to the data and not the data itself. That move was just phenomenal yesterday, Tom, across the board, in stocks and bonds.
Triple leveraged all cash. I'm waiting for Walmart.
You're not rotating. You're waiting for Walmart before you rotate out of cash.
I'm not in rotation right now.
Okay. Well, Lisa's spending. Very constructive on retail sales, Lisa is.
Business class.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The top names in global leadership are on Bloomberg.
The conflict between the U.S. and China has escalated so much. This is one of my greatest fears, that the small nation is forced to choose sides.
Bloomberg. Context changes everything.
We're not trying to decouple from China. What we're trying to do is change the relationship for the better. From my perspective, if in fact the Chinese people who are in trouble right now economically, if the average homeowner or the homeowner, if the average citizen in China was able to have a decent paying job, that benefits them and it benefits all of us.
A more constructive tone there from President Biden addressing the state of China relations before his trip to San Francisco, where he is set to meet with China's President Xi Jinping at the APEC summit a little bit later on today. Moments away, AMH on a West Coast this time. We'll catch up with Anne-Marie in just a moment. And also, in about 15 minutes' time, a little less than that, we'll get retail sales in America. The scores going into all of it. Equity futures look like this. We're positive on the S&P by 0.5% after a stellar day of gains on the S&P 500 yesterday. Higher by 1.43% on the Dow, Tom. On the S&P 500, up by 1.9. Yields are higher this morning by a couple of basis points. The 10-year TK, 446.28.
It's going to be interesting. We're 12 minutes away from retail sales. It's a nominal number, so if there is disinflation, if there is price decline.
We were higher, Bramo, by 490 points. You know, it's a big deal yesterday. Good move.
You're going to let him do this. Yeah, how long is he going to be quoting Dow points? Seriously, is this a new thing?
It's a new thing. It's a new thing.
It's a new thing. I'm becoming very mainstream.
Very mainstream.
It's a new thing.
Let's move on.
It's very good. Retail sales here in a couple moments. That'll be a really important review. Mike McKee, I believe, helping out this morning. She is in San Francisco, and for San Francisco, domestic politics is a spruced up the city. It goes back to the Moscone Center. She's outside the Moscone Center for this summit. Anne-Marie Horton joins us for the pageantry, the diplomacy today. Let's just cut to the chase. What's the schedule today, Anne-Marie? What should we wait to observe for? And at what time of day should we tune in?
Well, you're going to want to tune in later in the afternoon on the East Coast time, because that's when President Biden's going to be addressing reporters about this sit-down he had with Xi Jinping. And yes, I'm in central San Francisco, where you see heads of states descend on, CEOs descend on for these meetings with Xi Jinping and also the broader APEC summit. But more importantly, the estate is gorgeous, where President Biden will be sitting down with Xi Jinping, and that is south of San Francisco. So the everyday onlookers here are not really going to be able to get a sense of Xi Jinping and President Biden in San Francisco, because they are moving that out of the city, obviously for safety concerns, but also to, I think, evoke that vibe that we saw when Xi Jinping visited President Obama, also on the West Coast. And it was supposed to be a little bit more relaxed environment so they could really get to work and have a serious dialogue and frank conversation.
Anne-Marie, the president will enjoy his 81st birthday here on November 20th. Truly, of our politicians, he and a select few have lived the permutations of this relationship. How does the White House perceive Xi versus the history of China?
Well, this White House wants to get this relationship back on track. Obviously, Xi Jinping and President Biden are walking into this meeting after a year of true acrimony between these two individuals. At this moment, one of the highest priorities for the White House is just to get basic military-to-military communications back to a normal cadence. And that's really what President Biden said yesterday before he departed the White House, before he came to San Francisco. He talked about the fact that he just wants to get back to this relationship. We don't want to decouple, but they want to set ground rules. The issue right now, what they're dealing with, and the president gave a little bit of a poke there to Xi Jinping and what's going on in his economy. He talked about the fact of the matter is that in China, the economy is struggling right now. And that's the China they're dealing with, an economy that is struggling, but a Xi Jinping that many critics are very concerned with is moving into and becoming a little bit more of a hawk when it comes to the military side of the CCP.
Do we have an understanding, Anne-Marie, of who's going to be attending the CEO dinner later tonight with Xi Jinping and what the tenor of that's going to be?
Well, I think a lot of people, at the moment, we don't have a full list of who is attending that dinner. We don't know who's going to be here at the summit. Likes of Jane Fraser, Elon Musk, Satya Nadella. These individuals likely are going to be sitting down with Xi Jinping. There's also almost seems like two dinners happening, a bigger one where Xi Jinping will be meeting a lot of people, and then a smaller one that can have a bit more frank conversations with chief executive officers. And really, China wants to make clear when Xi Jinping meets with these CEOs today, they want to assuage those concerns that China is open for business. China is investable. And I go back to the comments that Gina Raimondo, the Commerce Secretary, made in August. She talked about the fact that businesses continuously tell her that they're nervous to invest in China and that, quote, China is uninvestable. For Xi Jinping, that is very worrisome, and that's why the CEO dinner and these meetings are incredibly important for him and his economy.
Janet Yellen's dinner was something of a subject of discussion, including your own reporting, as she was seen getting a cheeseburger with onions and fries and a Diet Coke and an In-N-Out burger on the way to the airport to meet Xi Jinping. What's her role in this, given that she did meet already with top-level officials from China and laid the groundwork for what we're going to hear possibly later today?
I have to say, that's some of the best reporting I've ever done. Be able to understand what delegates are eating before they meet world leaders. And by the way, that stop was totally impromptu. It wasn't scheduled as a PR stunt. She was on the way, she was hungry, and she says, I want a burger. And if you live on the East Coast, it's one of the first things you do when you get to the West Coast. But in all seriousness, China sees the Treasury Department as a serious broker and a way and a path forward into this relationship in Washington, D.C. It is likely why the Biden administration sent Treasury Secretary Janet Yellen there. She obviously went to Beijing. She had that first meeting here last week with her counterpart, and she's been setting the groundwork for the meeting that is going to happen later today between Biden and Xi Jinping.
I have been to the LAX In-N-Out, TK. It's a good one. I've been to that one, that
They're
particular
not the
location.
Same. It's like Ben's Chili Bowl at Reagan.
You're saying they're different in different places?
They're different airports,
Okay.
not the same.
He's done the tasting tour.
You know, I sometimes I can't get up to U Street.
I've gone to another In-N-Out outside of LAX, TK, and it's pretty much the same. What are you talking about?
You know, I just think, you know, I mean, AMH, they could go to one of the great diners in San Francisco with Yellen and chow down. I can see it, you know. I mean.
Okay. All right. MH, thank you. Tremendous reporting, yeah.
Yeah.
Anne-Marie, on the ground on what Secretary Yellen had to eat.
She put that on the Amex.
To be clear, I think the challenge in front of Xi Jinping today is incredibly difficult. I think it's a really, really difficult needle to thread for the following reasons. He can only control what he can control. And there are some things that he can do to make it a more predictable investment environment for corporate America. And certainly he's disrupted that in the last 24 months. I think a lot of corporations would point to some of the moves they've made that have made it much more volatile and unpredictable, without a doubt. But at the same time, Lisa, he also needs the United States to play along. And I'm not sure the direction of travel for this relationship changes today in any way, shape or form. I think today is about just dialing the temperature down, just playing happy families for a little bit. But are we ultimately heading in the same direction? I think so. And for that reason, there's a lot of corporate America who have looked elsewhere. This whole deglobalization, pick your word, I don't really care what you use, but ultimately, friendshoring, nearshoring, Lisa, that's been the direction of travel now for the last few years.
How do you give people a sense of policy security where there's been none? Right? There's been no sense of exactly how the relationship between the U.S. and China will really evolve, given some of the discord over the past 24 months. So given that, what can they say in one make nice meeting that's going to alter businesses that have to have risk scenarios, and the businesses that were really dependent on China before, looking increasingly long-term to diversify?
I would defer to Enda Curran and Steve Engel on this, and I think the great unspoken here is those executives saying, what did you do to my Hong Kong? Every multinational American corporation has some form of entrenched relationship in Hong Kong that's been blown up.
Some they're petrified of talking about it.
Every single chair.
Petrified.
It's what we're talking about, they can't talk about.
Yeah, they don't want to talk about it at all.
Can't talk about it.
That's where the situation is.
But they've been blown up.
Oh, without a doubt. Without a doubt.
No question about it.
What can you change here? Maybe you can say, yeah, we'll commit to doing some more business, but the data point that stands out for all of us in the last few weeks is foreign direct investment into China turning negative.
Right.
Tom, turning that super tanker around is going to take more than one meeting on the West Coast.
Well, yeah, and again, the idea, I'm looking as a surprise here, some form of discussion on tariffs, but that goes back to domestic U.S. politics.
U.S. retail sales coming up next. Stay tuned for that. Equities are higher going into it. And the next hour on Bloomberg TV, Vishy Tripatura of Morgan Stanley, Evercore's Julian Emmanuel, Marilyn Watson of BlackRock on the everything rally of the last 24 hours from New York City. Good morning.
tag on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer today on Bloomberg.
Bloomberg Surveillance, Lisa Abramowitz and Tom Keene. We've been looking at the Abramowitz spending pulse here into retail sales. The measurements of consumer, fascinating right now, particularly after what we saw yesterday.
And particularly the breakdown. The key question for us is also how the market is really going to respond to some sort of upside or downside surprise, given what we saw yesterday, Tom, given the incredible rally in bonds and stocks.
It's going to be interesting to see, and then to follow on to Michelle Meyer with her expertise at MasterCard. That will be something. Right now, out of control with a control group, Michael McKee on America's consumer and retail sales.
Well, sales are a little bit better than anticipated. We'll have to see what the breakdown is, but the retail sales headline comes in down 1/10. That is much worse than last month's 7/10. Actually, last month revised up to 9/10. Remind me, I got to tell you something about that in a moment, but the forecast was for a drop of 3/10, so that's good news. Take out autos and gas, and you're up 1/10. And retail sales control that Tom just mentioned, essentially the stuff that goes into GDP, is up 2/10. That's down from 6/10 in September. PPI is out, and it is deflationary. Headline falls by 0.5% after being up 0.5% in September. The core rate, which I put the trade number into as well, is at 0.1 after 0.3 the prior month. So we're seeing some significant revisions to the PPI numbers in the past. And then year-over-year basis, headline 1.3 and core 2.4. The Empire Manufacturing Index turns around, goes up to 9.1 from negative 4.6. So a lot to digest there. The one thing that I wanted to mention about the retail sales is that because they're so heavily revised and they come out halfway through the month and they get a lot more information generally, and I would assume that the distinguished gentle lady sitting across from me will be able to expand on this. You try to look at more than 1 month in a row and sort of average out where we are. So you look at 9/10, the revision up, and 1/10 lower, and you're looking at still a pretty good couple of months of spending. And all of this, obviously, impacted by gasoline prices, and it's all price-based. So.
On first blush, the markets look up and even up more than before, but then they give it back here pretty much level now. It's Dow 35,000. Futures up 19. They were up in the 20 level earlier. Dow futures up 112. The VIX 14.19. And Lisa, yields pop up a little bit here. It's not the 19 basis point yield frenzy we saw yesterday.
Not to be too speculative about knee-jerk moves up and down, but when the first numbers came out and it was retail sales coming in pretty much in line, if you take a look at the main control group, PPI deflation outright, yields plunged, right? Bond rally. Then you look at the revisions of retail sales. It was revised upward one read after another in the prior months. So you average these out, people are still spending, Tom, and that to me is really the key question behind some of the disinflationary narratives.
Michael McKee, is it too early for you to parse 15 pages of data and say what Amazon did? Do we know this online juggernaut?
Non-store retailers were up 0.2%. They're up 7.6% on a year-over-year basis. So people still spending some money there. Obviously, one of the bigger losers was gasoline, down 0.3, which is a little bit less than I would have anticipated, given that retail gasoline prices fell by about 10% during the month of October. Clothing and accessory stores flat. Maybe that's not a surprise after everybody goes back to school shopping in September. Sporting goods, hobby, musical instrument bookstores, the big loser, down 0.8%, along with furniture and home furniture stores down 2%. Motor vehicles, we knew unit sales had dropped, and you throw in parts and service and you get a drop of 1% during the month. Food stores up 0.6, grocery stores up 0.7, and health and personal care stores, I guess Tom got a haircut, 1.1% gain.
Lisa, this is important to bracket these two reports, folks. Lisa, roughly 5.04% 2-year, massive lower yield, way through 5%, 4.XX, and we've come back 4 basis points to 4.88%. So after these two reports, it's still a huge yield shift.
Which raises a question, does this just confirm the Goldilocks nirvana that we had yesterday, where basically we're seeing retail sales continue and disinflation or outright deflation in goods also continue, Mike?
Well, obviously, disinflation plays a role here because prices, this is all price-based. And so the fact that we have seen a decline in overall prices is going to subtract something from retail sales growth. I think the report kind of gives you something for both sides. If you want to say that the economy is slowing, well, 0.2 is significantly slower than 0.7 for the control group. If you want to say the economy is growing, it's still much better than anticipated, and we're still seeing strength in a lot of different categories. We do have to be careful, Tom, in how we analyze this, though, because Lisa only bought her refrigerator this month. So it doesn't show up in the appliance store sales.
Oh my God,
that were up 0.6 this month.
Talked about refrigerator ever in the history of refrigerators. No one needs to hear, Tom, anything more about this refrigerator. Carry on.
The Dolce & Gabbana $55,000 smeg. Michael McKee, don't be a stranger. Stay with us and continue to dive into the data. This is a joy. What happens with young economists is you read their research and you go, oh, they're quite competent. Not long ago and far away, but a few years ago, that was Michelle Meyer absolutely owning the parsing of the American consumer. She worked for a small bank in Manhattan and is now chief economist North America for MasterCard Economics. You own the analysis. I put you and Ellen Zentner together. You own the analysis of the American consumer. Have we stopped spending?
We clearly have not stopped spending, far from it. I mean, think about the data this morning. It was an incredible combination of continued strength in retail spend, a rebound in Empire State manufacturing, which shows that there's still a need for more goods production, which is because consumers are still spending. And on top of that, you're getting some relief on the pricing side. So it's a really nice combination.
I hate asking this question, and I'm stunned. It's my first time I've asked it on November 15th. What's a holiday season look like? What's Black Friday and then Black Monday and this and that? What does this retail madness to January look like?
Well, it is a longer holiday season. We've learned that over the last few years. And it's a heavily promotional-based holiday season. And part of that is because of the fact that there's so much demand out there to buy online. I mean, think about the net numbers we just saw this morning. Our spending pulse numbers saw just over 8% year-over-year growth in e-commerce sales. So, you're seeing a consumer that is certainly exploring many different channels of spending, including online, and that creates a lot more opportunities for them to get products. And it also creates a lot more need for retailers to compete with these big moments in time where they offer promotions. And I think that's what's going to be indicative. So we'll learn a lot from the Black Friday period, and it's approaching very quickly.
How sustainable is this combination of both robust retail sales and disinflation, or even outright goods deflation?
So I think you have to consider the different categories. I mean, when you looked at CPI yesterday, you certainly saw some categories like these big durable goods, like your refrigerator, it's back, seeing some price declines. But for many other things, like many services, for example, you are still seeing some price increases. So part of the drop in prices for some of these goods simply reflects the fact that prices increased too much coming out of the pandemic because of supply chain issues, because of higher costs. And now it's reverting a bit more to something more normal, right? So that means in real terms, you will see some support in terms of some of these items moving through. In nominal terms, you could see some move down in terms of overall spend. So it really depends on why inflation is moving, and that is a function of the type of product and how things evolved coming out of the pandemic.
When you put it together, does this seem like a recipe for this Goldilocks soft landing, or does this seem to paint the picture of a Federal Reserve that needs to do more and of an economy that has way too much momentum to really achieve the disinflation that a lot of people are baking into market valuations?
I think the data is shaping up in a way that's really favorable at the moment, because you continue to have economic growth. Look at the third quarter GDP numbers. That was fairly broad-based economic activity, not just consumers, but also businesses investing, inventories getting much more manageable and in stock. So, you know, things have been evolving remarkably well in terms of the real economy taking out some of the excesses, labor market coasting into a little bit of a slower trajectory for job growth, but still expansionary, while you get this relief on the inflation front. So how much of that is because of monetary policy? How much of that is because of the nature of the shock that we had initially? We'll see. It's probably a bit of both, but it's evolving really quite nicely, and obviously exceeding many people's expectations out there.
We talked about the interest expense and the debt and the deficit earlier with Maya McGinnis. Let's talk about the average charge card is 25-26% interest, migrating up now to 28-29% interest. I find 30% to be almost criminal, but you people look at this daily. Is that interest rate goes up, do we spend less?
So what we're looking at overall is how monetary policy is transmitting into the economy broadly. So when you think about who's borrowing out there, there's companies that are borrowing in terms of their expansionary needs. There's consumers that are borrowing in terms of whether or not they want to buy a home or a big ticket item that might require some leverage. So higher interest rates are certainly transmitting into the economy. You can see it today with the retail sales number that Mike just referenced around housing related items, furniture, some of these bigger ticket items that require debt. You are seeing some hit to those types of spending. So I think the high level of interest rates goes back to Lisa's point around how the Fed is trying to calibrate this economy with some easing of real growth, but still allowing inflation to come down.
Okay, you're out of the game, but I'm going to ask you the game question here, which is, what is your 12 months forward real GDP? Like, what's your 2020? You're talking to fancy people at MasterCard, and they don't want to know about charge cards. They want to know what Michelle Meyer thinks about the economy. What's your 2024 real GDP call?
So the good news is that I'm still in the game, in that we are still running our forecast.
We're still
absolutely. That is who I am as a person, as an economist. When I look ahead, I mean, this year we had an economy that ran above its underlying trend. So we're trending right now, given where GDP is, for real growth somewhere between 2.4% right now in 2023. As we look ahead to 2024, we're probably going to see some moderation closer to the underlying trend growth rate of the economy.
Sub 2%?
Closer to trend.
She didn't answer me. See, she's still in the game.
I'm still in the game.
I got the total Michelle Meyer not answer. Go away. Michelle Meyer of MasterCard there in their Economic Institute, which is brilliant work. Yes, it's linked into the charge cards and the damage we do, but it's also about the greater economy. Futures, they've got back a little bit. It's not the festivities, the addiction of yesterday. I want fireworks.
Let's go through it. The S&P up by 0.3%, so still solid on the day. Tom, I do want to bring this to you, just crossing the terminal, that SpaceX is discussing an initial public offering for its Starlink satellite business. It's been in the news quite a bit about providing reception satellite operations for a host of different countries. It could come as soon, this IPO, as 2024. They're already laying the groundwork for it in terms of isolating some of the resources into a separate unit. A lot of questions, though, here about how this will potentially percolate out.
Well, yeah, it's just a ton of satellites up in the air, right? I mean, essentially, it's taking the internet in orbit. It's just that simple.
He dominates it, right? And he's been in the focus very much of who he provides Starlink access to. It's been controversial and also highlighting just how strong his presence is in terms of global interconnectivity. We will continue looking through as we get more details, but I just wanted to bring that to you. Just on the retail sales, to me, again, it just sort of permeates this feeling that we're heading toward a really good setup, Tom, heading into next year, with people kind of pushing out that recession forecast even
pushing,
a little
I'll
bit
say,
further.
big time pushing out. There's no question about that. And I go back to the arch difference. We did not talk to Michelle Meyer about this, but the basic idea of when does this labor economy break? And that's a recalibration we have to make in the first week of December.
If companies are still investing, people are still buying, what's going to be the trigger, right? I mean, you're not seeing it in earnings. Margins are coming in better than expected at company after company.
We'll have to see. We're going to go to break here. Michael McKee is with us, and he will dive into this through the morning for all of Bloomberg Radio and Bloomberg Television. Futures up 20, now up 11. Stay with us. Bloomberg Surveillance.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper. One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
That resilient growth story can run. I don't think a recessionary threat is immediate as we look to the first half of next year. And as I said, with rate hikes in seemingly behind us, that can support momentum, along with like a reasonable amount of cash on the sidelines looking for a home.
And maybe they're finding it in risk assets this morning as well. Ben Guterich, investment director at Invesco Investment Solutions, earlier this morning talking before we got that retail sales report tied with the PPI data that came out and continued on this feeling of Goldilocks that really has permeated throughout markets so far this week. Tom, we still are seeing a lift to stocks. Bonds a little bit softer here. Yields up on the 10-year, up 6 basis points.
Fascinating to see how we open here. We're going to do this in 45 minutes. It's going to be after what we saw yesterday. I love what Rabila Farouk wrote up at High Frequency Economics on retail sales. She says, you know, the fact is they're really good. And there's this one phrase which goes back to the arch debate of Monday, which seems ages ago, a still strong labor market. And again, all of this Fed analysis is centered around not rates, but what does the American job economy do?
The economy,
Farouk's making clear it's a still strong labor market.
The economy is still holding in. Just want to take a look at some names that are highlighting that point this morning. We did get earnings from Target as well as TJ Maxx. Tomorrow we get Walmart results. What I find interesting is where the bar was set going into this. Target outperforming, talking about better than expected third quarter earnings, showing inline expectations for earnings, but also just inventories coming down 14%, really highlighting how much they've turned that story around, up down 14% those shares.
I did not know this. Target, PE 15, Walmart, PE 31. I had no idea the premium of Walmart to Target.
It's been a massive underperformance for Target. We're getting that back maybe a little bit today. TJ Maxx, a bit softer after giving guidance that was underwhelming, talking about not necessarily upgrading how much they expect sales to increase despite the active sales forecast that we just heard from Michelle Meyer there, Tom.
Well, see it. You know, what's great about this is we don't talk to Sowerby until the Russell goes up 5%. I mean, that's all there is to it. You don't talk to David Sowerby and you get a true jump condition.
So let's get there right now. David Sowerby, portfolio manager and managing director at Ankara. You buying the Russell this morning? Are you seeing, Goldilocks and rainbows and lots of wonderful things that give you lots of confidence?
Lollipops and puppies too, Lisa. It's not just that small caps can rally, but large caps can too. Tom and I had a conversation about 10 trading days ago on the radio, and I made the reference that if Jay Powell is the head lifeguard blew the whistle, get back in the pool. You had likelihood of less Fed tightening, pausing. Sentiment, unusually bearish. That's a good contrarian indicator. And out of third quarter earnings and cash flow, that's been very good. Margins, free cash flow margins, 11%. That's above average. And companies are growing their dividends better than 10%. You're never going to get all the stars aligned. Nevertheless, blow the whistle, back in the pool, be a net buyer.
David Sowerby, the fact is, when they move, they move. In 2003, 20 years ago, Russell 2000 up something in the vicinity of 40, even 45%. Do you suggest we could see that, given this titanic shift in rate and inflation belief?
I think the relative performance of small caps to large caps sets the table that small caps can meaningfully outperform. You've got valuations at roughly the same levels I saw in early 2000 when small caps were on their back. People were saying, why own small caps at all? I can own large caps and maybe alternatives like private equity instead. And yet small caps delivered for an extended period of 5 years or longer. So I think that the setting is very good. And the real key was interest rates peaking and starting to decline.
Right.
That's been the real catalyst for the small cap move recently.
Is there a magnificent 7 in mid caps? Forget about the small caps, but in the sort of kind of like caught in the middle, almost large caps. Are there tech type companies there?
Less so. You don't have, out of the 2000 and the Russell 2000 index, we know more than 30% of them don't make money, but you still have a pretty robust fishing hole to be buying stocks. So today is retail day. Let's talk about 2 small cap retail stocks that look appealing. One is Vera Bradley. They make handbags, home accessories, luggage. They've got no debt, generating very good free cash flow, buying their shares back. Only 2 analysts follow this company. You've got a better opportunity to find value when you've got fewer Wall Street analysts than more. So that's one example. And if you move to the fast casual dining space, Potbelly is growing their free cash quite handsomely. Also very good balance sheet. It's quick service sandwiches. They're growing their stores more than 10%. That's good unit growth. Those are 2 good small cap names to keep your eye on, knowing that there's no Bloomberg Magnificent 7 among all the small cap stocks.
All right, let's talk about some of those small cap businesses and just how rates higher for longer will affect them next year. If, let's say, the strength that we're seeing in the retail sales, yes, we are seeing disinflation. If we see rates staying around here, how much do these companies get really squeezed by the fact that any kind of downturn in sales, they can't borrow to offset that without paying a punitive rate. They can't necessarily hire cheap employees because the salaries have gone up as much as they have.
I think whether it's small cap or large cap, the higher interest rates posed an element of squeezing. So when you have so many opportunities to buy in the small cap space, much like their large cap siblings, they were able to extend their debt to move from floating rate to fixed rate debt. That's a very good move. And you've seen that prevail not just in the large cap, but in the small cap space, where so often we just pay attention to the income statement, earnings per share, really focus on the cash flow statement and the often forgotten in the trinity, the balance sheet. And if you put those two together, you can find very good opportunities in the small cap space where you have the potential for double-digit returns in 2024.
David, what is the efficacy of active versus passive index in mid-cap? Is it worth stock picking, or do you just buy the given mid-cap ETF?
Tom, you'll never hear me say the overused phrase, it's a stock picker's market. However, my parents raised me, don't play for a tie, be an active stock picker. And whether it's large cap or small cap, you can buy a small cap portfolio of 50 companies, be very well diversified, not the whole 2,000, especially given so many companies are not profitable. It is a better backdrop to be an active investor, given breadth is going to widen out in the market, and that favors the active investor versus the passive investor, without talking my book as an active stock.
Well, you are. You're talking your book. Thank you, David Sarby. Thank you so much. My senior executive, Starlight producer Qantas, says, Tom, we got to talk about Apple now. Too much mid-cap chat. David Sarby, expert on mid-caps and small caps as well. That's such a pleasant relief from our total fixation on what, 15 stocks, 20 stocks?
Those stocks have driven everything, and what a lot of people are saying is they will probably continue to into year end. I just want to note something. There was a shift today, a slight shift around the margins, not like yesterday, which was much more dramatic and much less nuanced. But there seems to be a little doubt creeping into bond markets as stocks tier.
Back 5 basis points.
A little bit of doubt about whether the Fed really has won this, about whether inflation really is gone. And you could see no rate cuts being priced into the meeting for the remainder of this year. And now rate cuts are slowly being priced out along the curve later next year.
I agree. There's a real subtle dynamic off these two shock reports. We're still up 17 on futures, but we're up 20, even 25 earlier. Dow futures well over 100 points, not just up 88. But, you know, there's a lot of soul searching going on. You know, we make light about it. We make jokes here to keep the coffee going. The Sanka this morning was awesome. But the fact is, this is really serious stuff. And there's a lot of global Wall Street people whose jobs are in jeopardy because they were some relative of caution or even gloomy. I mean, what happened yesterday is a serious thing to people's livelihoods.
We are seeing the Goldilocks transpire that people said was pretty much impossible to achieve. The data is suggesting that is what is actually happening. Whether it's a moment in time or whether it's something that is sustainable is really the unknown. Can we get strong sales and disinflation for the foreseeable future?
The data check into the close here, up 16, Dow futures up 82, the VIX 14.19, as Lisa mentions, yields higher off the stunning moves yesterday, 4.49% in the 10-year yield. Really can't say enough about the coverage the last couple days. Mohamed El-Erian scheduled Friday. Good morning.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, in 5 years from now, we will not have sacrificed, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
What a monster move in the last 24 hours. Live from New York City this morning. Good morning, good morning. That move continues, up 1/3% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, markets declaring victory in the fight against inflation. The House easing the risk of a government shutdown as President Biden meets with Xi in California. We begin with the big issue, a declaration of victory.
The Fed has been able to take the heat off of inflation.
Investors should be celebrating.
And essentially softer inflation prints.
Across the board, there's disinflation.
All of this points to a Fed that just does not need to be as restrictive.
The bar is high for another hike.
Really high.
I think the market reaction is a bit premature.
The Fed is not going to, take its applause and take a bow with just one data print.
They're going to stay pretty tough in holding their line against an early declaration of victory.
They don't want to declare victory yet.
They're very nervous about declaring victory and then having to undeclare victory.
They're really going to wait to see through really the first half of next year to make sure that the data continues to confirm that inflation will fall.
It will be on hold.
That period of pause has now begun.
We're going to win this thing.
We're going to win this thing. We're going to have that conversation right now with Evercore's Julian Emmanuel, Morgan Stanley's Vichy, to Repertoire. Julian, first to you. Are you ready to declare victory?
Look, we never want to declare victory on anything, because when you get too overconfident in something, that's when markets turn around and beat you over the head. But the fact is whether it's turkey prices or gasoline prices or diamond prices, whatever, the trend of lower inflation, I don't want to say disinflation, but the trend of lower inflation is very much intact. And Ed Hyman has been talking about inflation with a 2% handle in 2024 for a number of months, and the market sees that that's going to be the reality.
Vishy, there is so much happy talk going around in the last 24 hours. Reality check from Andrew Holdenhorst over at Citi. Here's the quote. The reading does not change our view that underlying inflation is likely to remain stuck above 3%. In fact, the risks of sustained higher inflation rise with the re-loosening of financial conditions. Vishy, how do you look at things now?
We think that over the course of 2024, we will see inflation gradually come down. We might still be a shade above the target rate of 2%, the Fed's target core PCE rate of 2%. We might still not get there by the end of 2024, but the path towards getting there, we think it's pretty clear. So we will see economy slows. I think the Fed will maintain restrictive policy for perhaps the first half of the year, and we will start seeing cuts in the second half of the year, and make substantial progress towards the target without actually getting to the 2% target in 2024.
Vishy, that's your view for next year. What do you think the bet is in this market right now? Is it that CPI can get to 2% without recession? Is it that these disinflationary trends are so powerful the Federal Reserve can go on an aggressive rate-cutting cycle? What do you think the bet is embedded in financial markets now?
I think that what the markets have priced in is a pretty smooth transition from the macro environment we're in into a smooth soft landing is very much in place pretty much across the asset classes, across various markets. In fact, that is in our view, this smooth macro transition is the key to following here. There is very little room for error for markets. Markets are priced for this to already happen. Whether you look at credit markets, you look at the equity markets or elsewhere, this is very much in price, and there's not a lot of room for things to go wrong.
David Costin at Goldman saying the same thing. They're looking for 4,700 on the S&P 500 year end. Not in 2023, in 2024. And with this far away from it right now, we could well get there, Julian, before the end of the year based on a price action of yesterday. Their view is interesting, Julian. They're really constructive on growth in 2024. That's Jan Hatzius over at Goldman. David Costin on the equity side saying despite that, this view is already reflected in equity prices. How constructive is the price action for you, Julian, after the moves we've seen in the last day?
Well, look, there is, again, no arguing with the price action. Price has been paramount, frankly, since the moment that oil began falling in the wake of the Middle East conflict, contrary to everyone's expectation. But if you think about 2024, the challenges to economic growth we think are still there. Frankly, if you're not calling for a recession at all, and you think growth is going to be stronger, and you think the Fed is done hiking, certainly as we do, you should probably be thinking higher than 4,700. We think it's not going to be that smooth path. There are likely to be growth hiccups. You think of all the geopolitical challenges. You think of an election coming next year. You think about the fact that earnings themselves haven't grown in a year and a half. All of those mean the path is not smooth, but we do think that the scope for higher prices remains.
Julian, the moves yesterday, best day in the S&P since April. Small caps, best day of the year so far. The Russell up by more than 5%. Real estate on the S&P, best day of the year so far. Julian, I think it's really important to reflect on the fact that this came off the back of a really small downside surprise on inflation. Julian, we often say on this program, many other people in the market say it too, you can learn something from the data, you can learn something from the way the market responds to that data. What did you learn yesterday from the way this market responded to a very small downside surprise on CPI?
The psychology around a number that printed 0.0, very, very profound in an environment where, look, think about it, in the small cap Russell 2000, we undercut the 2022 bear market lows 2.5 weeks ago. The most hated group of stocks, uninvestable, a smaller aggregate market cap than a number of the Magnificent Seven. All of these negatives feeding into the fact that now, if nothing else, talk of the Fed needing to raise its core PCE target from 2% to 3%, that's been retired. All of that fed into the positive.
Julian, the winners of yesterday, do you think they're the winners going into year end?
Well, again, if you look at last year, whether it's year end or thinking about the first quarter, there is an absolute strong reversion tendency. And we expect, as is normally the case, at some point between now and year end, the tax loss losers are going to outperform. They certainly did yesterday. And, multi-month, we do think that'll be the case.
We're still reflecting on the economic data of yesterday. We need to talk about the economic data of this morning. Let's get to Mike McKee for more. Morning, Mike.
Good morning, John. Another good day of economic data. Not quite as spectacular as yesterday, but we do see retail sales come in stronger than expected. The headline number drops a tenth, basically because gasoline prices fell. But the control group comes in up 0.2, about as expected, down from last month, but still showing that the consumer is out there spending. Remember, these are dollar-based numbers. So with the inflation numbers falling back, they're going to take something off the top of retail sales. PPI, look at that headline number, down 0.5%. We're 1.3% year over year. The core comes in up 0.3 for the month. It's now at 1 pence for the month, rather. It's now at 2.9% for the year. And the Empire Manufacturing Index turns around. So all the numbers pretty good this morning. Retail and control sales, as I was saying, are the kind of the key here for economists. And because retail sales were revised up in September, you combine the two and you get an 0.8 gain for the 2 months, which is fairly strong. And then control sales are up 0.9. Really good news overall for the economy, setting us up perhaps for a stronger fourth quarter than we had seen. The biggest takeaways: you got to do those combination average out numbers for revision because of the September sales strength. Gasoline sales were down 0.3. That's less than anticipated, but then you look over at producer prices, and gasoline prices fell 15.3% at the producer level, and that really pushed down on that headline producer price number. Goods prices were down 1.4%. Service prices were flat. In the CPI, service prices were up by 0.3. So perhaps some more disinflation coming. And John, the bottom line is we're where we were yesterday in terms of the Fed. Right now, we've priced out any more rate cuts, and we're looking at now the first rate increase perhaps very close to May.
Mike McKee, thank you, sir. Bank of America, they say this: we now think the hiking cycle is over. Citi, additional rate hikes, very unlikely. We saw this captured yesterday in the fund manager survey out of B of A. 76% say the hiking cycle is over. I think if you ask people again after the print yesterday morning, that number's going to be higher. A record 61% expect lower yields. Just 6% see higher CPI in 2024. Vishy, based on what's expected right now, based on your forecast for the next 12 months, what is the biggest risk for you? Do we get a material slowdown in this economy, or this strength that we've seen through 2023 persists into 2024?
I think the latter of those two that you just said. If we see we are expecting that the economy will begin to slow down meaningfully without going into an outright recession, and if we are wrong, where I'm more worried about if we are wrong is that the strength of the economy persists, and the progress that we have made in the path of the trajectory of inflation that reverses. That's the biggest risk, and we think the everything we are looking at, and the data from yesterday, the data from the labor, the non-farm payroll numbers a couple of weeks ago, and including the data, some of the PPI data today, all of that points to this transition in the direction we are expecting. We called for this to happen in our outlook that we published over the weekend, and I think the bigger risk, the risk for us, is that the slowing of the economy that we are expecting as a consequence of monetary policy remaining tight, restrictive for longer, that doesn't come through, and we see a stronger economy than what we've been hoping for.
Julian, do you agree?
We take a slightly different view here. Look, I think if we've learned anything in the last several months, it's that higher for longer is tolerable. Okay. And you're getting to the point in terms of thinking about the markets where the focus is going to move from inflation, from what the level of rates are, to growth. From our point of view, if you continue to have a reasonable growth, the Fed doesn't have to do anything. It can tolerate the financial conditions loosening, provided that inflation doesn't rekindle. And again, as I said earlier, we don't think that it does. But from our point of view, when you look at some of the inflections we've seen, look, yes, it is the unemployment rate, but it has inflected. What we're looking for is whether the actual jobless claims data start to accelerate. If that does, then we're going to, go back to this idea that the biggest risk is going to be a slowdown in the economy.
Interesting. More claims data coming tomorrow morning. This conversation is going to continue. Julian Emmanuel, Vichy to the Patur, about 20 minutes out from the opening bell. Equity futures here just about positive by 0.2% on the S&P. Let's get you some movers going into the open. Here's Abby.
Well, one stock that is certainly helping the slightly warmer open, John, is Target. I was about to say Target because the Target feeling is back. They put up a massive beat, $2.10 in adjusted earnings, 42% better than expectations on about $25 billion worth of revenue. Comp sales down, but less than expected. Leaner inventory is a big piece of it, and this stock is on pace, I believe, for its best day since 2019. JD.com up 6.3%, the Chinese e-commerce company. Their sales numbers beat lowered expectations, anemic growth, but investors are taking it. It's less bad. And then Tesla up almost 1%, a continued catch-up trade from its 35% July to October drop over the last couple of days, John. This stock up nearly 20%, which these wild swings tend to be more about emotion than informed investing. But if you're long Tesla right now, some of that, those investors might be liking that action.
Abby, thank you. Believe it or not, coming up, we've got some good news in Washington. Congress making strides to avoid a government shutdown.
We have broken the fever. We are not going to have a massive omnibus spending bill right before Christmas. That is a gift to the American people because that is no way to legislate.
The House passing a stopgap funding bill. That conversation up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Was going to keep Great World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
What we need to do is avoid the government shutdown. Why? Because that would unduly harm the American people. This allows us as conservatives to go into the fight on the next stages of this, to talk about real border changes, policies at the border, to close the southern border, to get it under control, to talk about the oversight that's necessary on additional Ukraine aid, to get Israel done if they don't do it as we beg them to do. All these other matters in the supplemental, that puts us in the policy discussion, and we'll have stringent fights on principle and philosophy and cuts as well.
It's a victory for House Speaker Mike Johnson. Lawmakers passing a stopgap funding plan, easing the risk of a government shutdown and giving Johnson until next year to negotiate annual spending. The bill now heads to the Senate. That chamber aiming to quickly send the legislation to President Biden, avoiding drama before Friday's deadline.
We would like to do it as soon as possible. Both McConnell and I want to avoid a shutdown, so getting this done, obviously, before Friday midnight. You know the Senate has lots of arcane rules, but McConnell and I are going to work together. We talked about this yesterday, to get it done as quickly as possible.
Over in Washington, D.C., Katie Lyons joins us now. Morning, Kaylee.
Good morning, John. It's unclear just how quickly is possible, because what the Senator Chuck Schumer was alluding to there is the fact that in order to accelerate this in the Senate procedurally, it is going to require unanimous consent from all 100 senators. So that is potentially where there could be a hiccup in terms of timing. You already have one Republican, Senator Rand Paul of Kentucky, who has said he will not support this CR, will introduce his own. It's unclear if that means he's going to hold things up procedurally. But at the end of the day, John, it does seem like the Senate is set to pass in a bipartisan manner, just as the House did yesterday, this continuing resolution and send it to President Biden's desk, where he is expected to sign it. And they do have some time to do this. The deadline, of course, is midnight Friday. Now, this continuing resolution essentially will just kick the can down the road to two different dates early next year, January 19th for one batch of funding and February 2nd for the other. The thing is, though, John, they are still going to have to, between now and then, reconcile the different priorities of a Democratic White House and Senate with a Republican-led House where hardline conservatives are pushing for deep spending cuts. They, of course, did not get that in this continuing resolution. It was clean, meaning it keeps funding levels steady. That's why you had more than 90 Republicans voting against the measure in the House yesterday. So that is going to be the difficult work ahead, actually trying to put together appropriations bills that can get buy-in from everyone here in Washington. That just means shutdown risk, theoretically, is punted until early next year. We could very well be looking at a January or February shutdown still. The other question is, because you do have those Republicans who voted against Mike Johnson, what becomes of his speakership? Of course, it was Kevin McCarthy earlier this year who was ousted because he passed a clean CR with Democratic support, which is exactly what we saw happen yesterday. It does seem like Johnson's going to be granted a little bit more grace, but that certainly is still something overhanging the Capitol. And then, of course, the other thing, John, is this continuing resolution doesn't include funding for Israel and Ukraine. What the path forward for that looks like, how border security measures may tie in, remains unclear, and the timeline also unclear this morning, John.
Kaylee, thank you. There is going to be a massive fight over spending in Washington, D.C. in the new year, based on events of the last 24 hours on Capitol Hill. We hope not literally. Julian Emmanuel, Vishy Tripatur, back with us for more. Vishy, let's look at the numbers out of Moody's that came out on Friday going into the weekend. Moody's sees federal interest payments relative to revenue rising to around 26% by 2033, from 9.7% in 2022. Vishy, how big is that fight going to be next year over spending?
I think we'll continue to see I would describe the dysfunctionality in Washington to last for longer, and I think that's something we just have to get used to. We have seen this movie many times so far. So I don't expect that challenge to be easily resolved, given the House, the political leadership in the House and the White House and the Senate being in the other party's hands. So I expect that to continue to be there. But I think to me the more important thing is, are we going to see a further fiscal spend? I think that's very unlikely. So I think what the markets are thinking about is we've already seen an expansion in the deficit. We have seen a lot of expectations of issuance required. A lot of that is now in price. So I think what we need to worry about is that incrementally, are we going to see greater issuance, greater need for issuance of treasuries? I don't think, beyond what's already priced in, I don't see that happening. That makes us constructive on duration and constructive on the longer end of the yield curve.
Vishy, does it make you constructive on lower volatility in the bond market? The reason I bring this up is because we're having another decent, sizable move today. We're up by 7 or 8 basis points on a 10-year, 452, after a double-digit move yesterday across the curve, 2s out to 30s. Vishy, do you think we can leave some of this volatility behind next year? Do we have the ingredients to do so?
I think the ingredients are there, but how they actually play out is still, it's still to be determined. We expect the volatility to be lower next year, but it's not. The road is not going to be that smooth. We are going to see some bumps in the road, and I think that's the path ahead. I think where it really depends on how the growth and the inflation data pan out.
Julian, you're an equity guy, but I know many times this year it's felt like being at the mercy of the bond market. Do you think the correlation starts to flip the other way going into next year?
Well, that's really going to be a function of growth, John. But what I think is possible here is if you think about it, right? Well, first off, look at yesterday between the actual fisticuffs and the verbal fisticuffs in the halls of Congress. It's just an indication of what's to come. And again, whether you're the speaker or you're the rest of Congress, the battle to get something done in a bipartisan fashion is probably going to be as bloody, if not bloodier, than the one that brought down the previous speaker. All that having been said, once we know what the budget trajectory actually looks like, it's probably a recipe for fixed income volatility to start calming down. And all else equal, that tends to be a good thing for equity market volatility on balance.
Julian, it's good to get your view. Julian Emmanuel, Vishy Throbator to the two of you. Thank you. Coming up on this programme, the morning calls and later, Target absolutely surging on the back of a big earnings beat. That conversation still ahead with BlackRock's Marilyn Watson. That stock is flying. Equity futures doing okay after a monster day of gains yesterday on the S&P 500, the biggest day of gains since April. Equity futures this morning positive 0.2%.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology. And welcome to Balance of Power. This is Bloomberg.
Equities positive here, just 0.2%, going into the open about 5 minutes away. That's the price action. Let's get you some morning calls. Your first call from Cantor Fitzgerald, downgrading Bristol Myers to neutral, $55 price target, warning investors the stock is a value trap. The second call from Bank of America, moving Netflix to its US One Focus list, adding shares to a collection of the firm's best investment ideas. And finally, JP Morgan upgrading VF Corp to neutral, highlighting an attractive valuation and improving margins. That stock is flying in the pre-market. It's up by a little more than 6%. Coming up, Target delivering blowout results, crushing quarterly profit and sales estimates. That conversation shortly with BlackRock's Marilyn Watson. Your opening bell is just around the corner.
will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Disinflationary enthusiasm of the last 24 hours overwhelming. About 20 seconds away from the up and about this morning. Good morning. Following the best day of gains on the S&P 500 since April. On a Russell, the small caps, the best day of the year. Futures this morning adding a little weight to that rally on the S&P, up by about 0.25%. There's your opening bow. Switch on the board and get to the bond market. Yields look like this on a 10-year. Bouncing back this morning by 6 basis points. Yesterday, double-digit move lower across the curve. 2-year out to 30s. 450. 59 on a 10-year. Up, let's call it 6 basis points right now. The dollar, worst day of the year yesterday for the US dollar on the dollar index. This morning, trying to bounce back against the weaker euro, 108.51. That currency pair at the highest since late August in yesterday's session. The dollar weaker against absolutely everything yesterday in G10 this morning. Trying to make some kind of a comeback. Crude lower by 1.3%, $77 and about 24 cents. About 30 seconds into the session, state of play right now on the S&P 500. Up, let's call it 0.4% higher on the S&P and on the NASDAQ. One stock to watch at the open, Target, shares jumping higher on better than expected Q3 results, fueled by leaner inventories and fewer markdowns. Abby has the story. Hey, Abby.
Hey, John. Yeah, this stock is absolutely soaring, up more than 13%, heading right now to its best day since November of 2019. And there's big relief here for investors in Target, because this stock on the year into today down more than 25%, really a combination of heavy inventories and weaker than expected demand, perhaps. Now we're seeing a bit of a reversal of that, or at least the company's learning how to manage this new environment, because CEO Brian Cornell just was talking about how it's still, they are cautious in the near term. They're saying that consumers are cutting back even on food, delaying purchases. But the good news is they beat earnings in such a big way by 42%, $2.10 in adjusted earnings, about $25 billion worth of revenue, basically in line. Comp sales were down, but less than expected, down 4.9%. And beauty is a bright spot. So again, I think that it is a matter of managing to learn the environment. As you mentioned, inventories down by about 14% year over year. Markdowns are less. And if we compare Target to Walmart, today, right now, Walmart up nearly 20% on the year. Target, again, into today, down about 25%. I think that really speaks to the idea that Target's caught in this spot of the value proposition, but sort of that Target factor. It looks like they're learning how to manage that. The stock up 13%.
Big move higher for Target. Abby, thank you. Target up by close to 14%. Would be, just to reiterate some of that, biggest day of gains going back to November 2019. So 4 years. Big day for retailers tomorrow. You'll hear from Macy's, you'll hear from Walmart, you'll hear from The Gap as well. We'll be on top of that for you. Just to turn to our reporting from Ed Ludlow here at Bloomberg on SpaceX, discussing an IPO for its Starlink satellite business as soon as next year in order to capitalize on robust demand. I'm pleased to say that Ed's jumped in front of a camera for us now. Ed, what's the latest?
Yeah, so sources say that the end of 2024 is possible, noting that it's also an election period, right? And then if not the end of 2024, 2025. The idea of Starlink being spun off is something that Elon Musk and Gwynne Shotwell, who's the president of SpaceX, have discussed in the past. What's changed is just that the business has such momentum. We reported a couple of weeks ago that next year Starlink revenues could be above $10 billion, meaning the majority of revenues overall from SpaceX alongside the launch business. John, it's important to note that I'm hearing from one source that what SpaceX is doing is moving Starlink and Starlink's assets into a subsidiary, incorporating it as its own private entity, a wholly owned subsidiary of SpaceX, kind of a stepping stone towards that. But immediately following publication of our reporting and our story, Elon Musk tweeted or posted on X, the platform formerly known as Twitter, false. He was responding to a user who'd taken a screen grab of the story. So for transparency, there it is. Musk saying that this reporting is false, but that's what we understand from our Bloomberg sources.
Ed, interesting reporting, sir. Looking forward to the coverage a little bit later on Bloomberg Technology at midday, in a few hours' time, alongside Caroline Hyde. I want to check in on shares of NVIDIA. NVIDIA right now is slightly negative by 0.1%. You have to think about where we've been. We've had 10 days of gains on this name. And think about what we generated in terms of gains over those 10 days. Over those 10 days, the stock was up by more than 20%. We're talking about $200 billion plus in market cap added to this company. This morning, just slightly negative. Let's see if we can make it day 11 as it flips positive, just briefly. Turning to the auto space, Advanced Auto Parts slashing its annual profit forecast and launching a $150 million cost reduction plan. Simone Foxman on top of this one. Hey, Simone.
Hey, John, this is actually the third cut to the fiscal 2023 guidance for Advanced Auto Parts retailer here, and a big one. Now sees EPS at $1.40 to $1.80, had previously, just as recently as August, seen $4.50 to $5.10 earnings per share. The estimate was $4.64. Third quarter, a little bit more mixed results. Sales beating expectations slightly, but margins really under pressure, some 36% versus an estimated 43%. As you mentioned, announcing that $150 million cost-cutting plan, as well as the divestiture of Worldpac, a wholesale business, as well as its Canadian business lines, as it really pushes into the big box space. Also announcing a new CFO, Ryan Grimsland, will join from Lowe's. This is after we got a new CEO for the company, Shane O'Kelly, coming in September as part of a strategic review. RBC analyst says, there are some positives here. This cost cutting, the CFO, the divestiture plans, these are all steps in the right direction. But Stephen Shemish also writing that we suspect investors will tread with caution given several false starts in the past. We are seeing that caution reflected in the market this morning with shares down well over 6%, John.
54.69. Simone, thanks for that. I said it was a big day, big 24 hours for the retailers. We had retail sales out a little bit earlier this morning. That came in better than expected. We had numbers from Target. That stock is absolutely flying. Tomorrow, you'll hear from Walmart, you'll hear from Macy's, you'll hear from The Gap as well. We also heard from TJX this morning, topping Q3 earnings estimates, but delivering a profit warning for the holiday shopping season. Katie Greifeld has this story. Hey, Katie.
Yeah, it is a rocky morning for TJX. Of course, we're talking about the parent company of TJ Maxx and Home Goods. And like you laid out, it's a similar story to what we've been hearing this earnings season. It was a pretty solid last quarter, but looking at the guidance, definitely a bit soft there. In TJX's case, the off-price retailer posted third quarter earnings of $1.03 per share. That was actually a beat. The consensus was for 99 cents a share. But looking forward, TJX said it expects comparable store sales growth to be between 3% and 4%, with EPS in a range of $1.07 to $1.10. So that comp stores forecast actually beat estimate, but you take a look at what analysts are looking for EPS. The estimate there is for $1.12, so a bit soft on that metric. You did hear from the CEO saying that TJX strongly positioned heading into the holidays. Of course, a crucial period for TJX and pretty much every other retailer, but you take a look at shares this morning, currently off by more than 3%.
Katie, thank you. About 7 minutes into this session, I have to say this is quiet relative to yesterday, where everything was just absolutely flying. The S&P 500 is up by, let's call it a third of 1%. On the NASDAQ, we're higher by almost a half of 1%. In the bond market, just reversing some of yesterday's moves. Yields aggressively lower. 2-year add to the 30-year bond this morning, just a little bit higher, up by about 5 basis points on a 2-year maturity, on a 10-year higher by 6. Let's call it 451. BlackRock's Marilyn Watson weighing in on the Fed's road ahead, writing this: while the Fed could remain in wait-and-see mode, we believe it's still unlikely they reduce rates anytime soon. Marilyn, I'm pleased to say, joins us right now for more. Marilyn, let's go to where things are at currently and where you expect them to be in 6 months' time. We've got inflation back to something like 3 to 4%, unemployment just south of 4%, and GDP in 3Q close to 5%. As you look at 6 months, Marilyn, where do you think those numbers are going to be?
Yeah, so we have, I would say, a relatively positive view on the US economy, and we certainly think that the data, as you mentioned, is continuing to show a very robust economy in terms of economic activity. But we're also seeing the progress in terms of inflation, start continuing to soften and come down a little bit. I think, however, it's still early days, and it's too soon to really tell that, we really are seeing inflation has been really in the trajectory that the Fed are looking to see. And I think also in terms of the economy, I think when you're looking at the labour market, when you look at the strong GDP growth, and you're seeing a massive, dispersion now between the US and other regions such as, the Eurozone, then, I do think that we're going to continue to see, pretty strong market. But, it's still too early to tell. We still have a lot of data to come through. And even looking at yesterday's data, a large number of components are still showing quite a lot of volatility. So, things such as shelter in terms of rental, that remains pretty sticky and elevated, energy and other things as well. So I would say, we're still, in a pretty uncertain phase. I think that's why the Fed is definitely probably watching and seeing. We're still continuing to see the impact of all the hikes that they've already implemented over the past 18 months or so feeding through. And now I think we're just starting to see the economy settle a little bit. We're starting to see really where it's starting to shake down. But I think overall we have a pretty positive view of the US.
Citi's Andrew Hollenhorst said this morning: underlying inflation is likely to remain stuck above 3%. Marilyn, given what you just said, do you agree with that?
So we do think it's continuing to soften, but I think it is too soon to say that it has been sort of brought under control and is coming down to the Fed's target of 2%. And there are a number of factors, as I mentioned, some including energy, some including the very sticky, housing market, shelter, things like that. We've also seen a lot of prices and inflation coming down in areas such as goods, in used cars, for example, and a lot of that may be already out of the numbers now. So I think there's still, a lot of volatility in the numbers, and we're still continuing to actually see the impact of the Fed hikes, but also of issues in the Middle East, of the impact of high energy costs and things like that. So it could remain above the Fed's target of 2% for some time.
Let's push that through the bond market then. So up until recently, we had a 2-year at about 525. A 10-year broke through 5% very briefly. The 2-year right now is at 489. The 10-year's back to about 452. If you had to take a best guess of where the next 50 basis points would it be for higher yields, Marilyn, or lower yields?
So I think, at the moment, I think the moves that we've seen recently suggest that obviously the market is expecting the Fed to remain on hold in December and to pause. I mean, so we are seeing a lot of volatility, and you have two conflicting sides to this. So on the one hand, you do have a huge amount of issuance coming through in treasuries, and we saw, for example, the week, 30-year auction last week. On the other hand, we do see, the improvement in terms of, the CPI data and other things. So you do have these two different sort of conflicting forces at work. So I think we're going to see volatility around these numbers, and it could actually go either way. But I think just given the huge amount of issuance, the fact that maybe some of the demand also for treasuries is dwindling a little bit, even as we see this increased supply, then it's really difficult to tell.
I think this is really, really important, though, that it doesn't change. Those things that you've explained don't change with the economic data that we got yesterday. We had this conversation with Vishitra Patur of Morgan Stanley about 20 minutes ago, Marilyn. This stock market wants to rally. I think what a lot of equity bulls would like right now is just for the bond market to stay out of the way. But as you've just explained, that volatility, Marilyn, might be here to stay. How unusual is this volatility in fixed income relative to what we saw pre-pandemic?
So pre-pandemic was also a very unique environment in that we'd had several years of monetary policy suppression, essentially. We saw effectively, rates come down and down and down. We had seen QE already implemented, years before the pandemic. And so we'd already seen years and years of really some of the volatility being taken out of the market by the fact that you had these backstop buyers, by the fact that you had, rates and spreads, really decreasing as well. And so volatility had been pretty low for a while, given all those factors. Then obviously you had the pandemic, you had, a huge spike in volatility, you had the unprecedented response from the Fed and other central banks as well, and governments as well. And now that we've seen rates hike again, and we're seeing them at pretty aggressive levels from where they were 18 months ago, then volatility has increased a lot. As you say, we're seeing a lot more dispersion between the price of individual bonds. And so I think it is natural for maybe bond yields to be more volatile than you would have seen in the era just prior to the pandemic, given all the monetary policy suppression that we had then. Volatility is likely to come down a little bit because it has been very elevated this year as the market really digested all these aggressive rate hikes from the various different central banks. But some level of volatility, I think, is to be expected. And certainly, as I say, I think some of the factors prior to the pandemic are no longer there today.
It's been a crazy volatile few months, that's for sure. And it may well continue. Marilyn, thank you. Marilyn Watson there of BlackRock. Thanks for the update, appreciate it. Equities right now about 14 minutes into the session, positive by 0.3% on the S&P, similar move on the Nasdaq. Coming up later, the attention's going to turn to this. President Biden and China's Xi Jinping meeting in San Francisco.
We're not trying to decouple from China. What we're trying to do is change the relationship for the better.
Team coverage up next.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The annual prize money pool in LPGA tournaments has grown 50% since 2019. In 2023, it topped $100 million. But the prize fund still lags far behind what men compete for on the PGA Tour. The inequality hits hardest at the lower end of the money list.
Clearly, we want the top players to continue to make a great living playing. These are the very best in the world. But we also then dig in and say, okay, what's the 50th best player in the world making, and what did she make last year? I've asked Kathy to run numbers many times to say, okay, tell me where we are exactly during the middle of the season, at the end of the season.
That 100th player, our goal would be to obviously have that player make considerable amount of prize winnings, and we're going to work really hard to do that. Having said that, we do need to continue to focus on ways to provide opportunities so that 100th best player can cover those costs that it takes for them to be out here on the golf course. That's hiring a caddy, that's travel, that's strength coaches. We're helping to provide stipends for health insurance or create a tour-wide health insurance program. Ability to create more discounts for travel, for hotel and car and all those things that really cost them a lot.
To meet these objectives, LPGA leadership collaborates creatively with sponsors.
We've worked with some of our corporate partners to say, help us solve a problem. Help us create a fund that will allow our players to get to the first tee ready to reach peak performance.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer today on Bloomberg.
We're not trying to decouple from China. What we're trying to do is change the relationship for the better. From my perspective, if in fact the Chinese people who are in trouble right now economically, if the average homeowner or the homeowner, if the average citizen in China was able to have a decent paying job, that benefits them and it benefits all of us. But I'm not going to continue to sustain the support for positions where if we want to invest in China, we have to turn over all our trade secrets.
Chinese President Xi Jinping arriving in San Francisco for a high-stakes meeting with President Biden during his first trip to the U.S. in 6 years. The leaders scheduled to meet at 11 a.m. local time. The bilat expected to cover key issues, including economic competition, military communication, artificial intelligence, and the status of Taiwan. But the hottest event of the week may be after hours. A number of U.S. executives and officials are expected to attend an exclusive dinner with Xi for a chance to air concerns and ambitions in a less formal setting. Your team coverage begins right now with Bloomberg's Kelly Lyons in Washington, D.C. and AMH in San Francisco. Anne-Marie, let's begin with you. What can we expect later on today?
Well, Jonathan, the real deliverable of this meeting is the fact that these two men, President Biden and President Xi Jinping, the leaders of the world's two biggest economies, are actually sitting down and having this meeting. It is coming off of some very frosty tensions between Beijing and Washington. So that's really the key deliverable. And you heard it there from the president. He just wants to make sure he can have more of a correspondence with China, being able to pick up the phone if a conflict arises. Another priority for this administration, Jonathan, is in the same realm of communications, but for military to military, to make sure that that dialogue can go back to pre-levels before Speaker Nancy Pelosi took that trip to Taiwan. That really was a downfall in these relationships. So that's really the low bar. And then, of course, Jonathan, the fact of the matter is both these individuals, President Biden going to an election year, wants to make sure he puts a lid on this relationship, set some roadmaps, and then Xi Jinping, Biden there spoke to it again, talking about the domestic economic issues at home. Yep. For him, it's going to be trying to get any kind of economic future out of the United States, whether CEO or with Biden.
Katie, that takes us to you. I think this is really important. How much of a charm offensive can we expect from the Chinese leader with corporate America?
Well, John, he's going to try to convey the message that China is indeed open for business after there has been a lot of conversation in recent years about China being a market that is uninvestable. This is something that has been echoed even by the Commerce Secretary, Gina Raimondo. Now, we know this CEO summit is taking place on the sidelines of APEC. A number of well-known business leaders will be there, including Satya Nadella of Microsoft, Darren Wood of Exxon, Citi's Chief Executive Jane Fraser. Elon Musk will be there as well. It isn't exactly clear who has gotten this exclusive invitation to dine with Xi Jinping. I would just remind everyone that Jane Fraser and Elon Musk have actually made trips to China within the course of the last year. So that just speaks to the idea that a lot of these leaders are really trying to figure China out. It is the second largest economy in the world. It is a vital market in terms of demand for many businesses, a vital market in terms of supply chains for many others. And yet we know China hasn't always been ultra friendly to business at the moment. So that really is what a lot of this dialogue probably is going to be about. Xi Jinping trying to make the case that China is open for business, and these business leaders may be expressing what they might need to see from China and really what they would like to do in the Chinese market. I would just keep in mind one thing. This is a conversation, John, I was having with one of our geoeconomics analysts, Gerard DePippo, yesterday, this idea that while the administration is messaging that they have no desire to decouple from China, a lot of this decision-wise comes down to private actors in terms of economics. And if you look at trade flows, if you look at foreign direct investment flows, if you look at the flows of people like students and tourists, the U.S. and China economically are moving moving more apart than they are moving together. And that really is the backdrop as business leaders get set to meet with Xi Jinping tonight, John.
Katie, looking forward to the outcome of all of this. Kenny Lyons, Anne-Marie, MH, great work as well over the last 24 hours. This just feels like reaching for the thermostat and turning down the heat, just a touch. That's what it feels like. Peter Chia of Academy Securities writing this: be prepared for the meeting this week to come across as highly conciliatory, prompting an everything rally into year end. This is what Pete has to say. We don't even need to see concrete actions taken. If the messaging is strong, that messaging should be enough to get the job done. We're about 22 minutes into the session, going into that meeting. We're positive by 0.2% on the S&P 500. Breaking things down, the sector price action. Here's Abby.
Well, John, it is a relatively small gain, especially compared to yesterday's big rally, but that S&P 500 gain of about 0.2%. It is a broad-based gain because 10 of the 11 S&P 500 sectors are higher, led by consumer staples, real estate, and utilities. Those defensive sectors, those dividend-rich sectors, they are higher even with yields up. Healthcare is the one sector down. And then, John, I haven't said this in such a long time. If we take a look at the sector in focus today, if you will, the S&P 500 tech sector, well, it is at an all-time high. Its second record high in 2 days. One question could be, is this something to come for some of the other indexes? This is basically Apple and your chips. So it's talking about if we were to see more record highs for other indexes, a broadening out of what's happening for tech.
Abby, thank you. Up next on the program, we'll take another peek at a calendar for the rest of this week. It's your trading diary up next.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
A little more than 25 minutes into the session, equities pushing higher by 0.2% on the S&P 500, following, of course, that blowout move yesterday. Big move on the S&P, biggest move since April of this year. That's the price action. Let's get to the trading diary. The week ahead shaping up as follows. The Senate potentially holding a vote on the stopgap funding bill later. Plus, President Biden meeting with President Xi at the APEC summit at 2 p.m. Eastern. Thursday, another round of jobless claims. Plus, earnings from Macy's, Walmart, and The Gap. Full coverage of that tomorrow morning. And finally on Friday, it's the US government shutdown deadline expiring at midnight, and I think we all hope we can avoid it. From New York City, thank you for joining us. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
On the next episode of the Business Week Show. Reputation. People say, well, LeBron gave you an opportunity, lucky you did this. But you don't talk about Donald Trump's dad gave him a loan, James Dolan's dad gave him a business. What's the difference?
I try not to care too much about what people think, and if that helps others see that there's more to life than a good reputation, that can be a positive step.
Watch the Business Week Show, Thursday nights, 10:30 Eastern on Bloomberg Television, or 8:30 on Bloomberg.com or the Bloomberg app on connected TVs.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Ed Ludlow. He's the host of Bloomberg Technologies out there in San Francisco. SpaceX, maybe spinning off Starlink. We'll get the latest there. Jen Bartashis, senior industry analyst at Bloomberg Intelligence. She follows all the retailers. So we're going to check in on those Target earnings from today, as well as Walmart reporting some numbers tomorrow. So we'll get the latest there. Jill Blanchard, president of Enterprise Client Solutions at Advantage. She's going to break down retail sales and risk to consumers, because guess what, folks? We are in holiday shopping season. It is upon us. So we'll break that all down. But first, let's check in with Nathan Hager and get a Bloomberg Business Flash.
Well, Paul, we're seeing stocks continue to hold on to gains. Treasuries are tumbling following a latest economic data that we could call a little bit mixed. Retail sales did fall less than expected last month as prior months were revised higher. Producer prices fell by the most in 3.5 years. MasterCard Advisors Chief North America economist Michelle Meyer says the consumer is still spending.
Part of the drop in prices for some of these goods simply reflects the fact that prices increased too much coming out of the pandemic because of supply chain issues, because of higher costs. And now it's reverting a bit more to something more normal, right? So that means in real terms, you will see some support in terms of some of these items moving through. In nominal terms, you could see some move down in terms of overall spend.
And hear more from MasterCard economist Michelle Meyer on the Bloomberg Surveillance podcast. Right now, the S&P 500 is up 0.25% or 11 points. 4506 is the S&P level. The Dow Jones Industrial Average up 0.2% or 80 points, trading at 34,907. The Nasdaq is up 0.3%, up 36 points, 14,130. 9 of the 11 main industry groups in the S&P are in the green, led higher by utilities, real estate, and consumer staples. The big outperformer this morning, Target. Those shares are up nearly 18% off the back of blowout earnings in the third quarter. 10-year Treasuries down 22.30 seconds, yield 4.53%. The 2-year yield is at 4.90%. NYMEX crude's down 1.2% at $77.36 per barrel. COMEX gold down about 0.25% at $19.6130 per ounce. The euro 1.0836 against the dollar. The yen is at 151.15. That's a Bloomberg Business Flash. Bloomberg Markets is on with Paul Sweeney and Matt Miller.
All right, Nathan Hager, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, we are live here in our Bloomberg Interactive Broker Studio in New York City. We're also streaming live on YouTube.com, and we're also on that in your car, and I'll get that stuff to you in just a moment. You can go to the Apple CarPlay or whatever the Android equivalent is, and we're right there. Boom. So that's some good stuff. Markets higher again today, following up on that big move higher yesterday. We had the S&P up 0.25%, so that's nice. Lots of earnings out there, lots of moving parts underneath the hood. So let's check in with Bailey Lipschultz. He covers all that stuff for Bloomberg News. Billy, what do you got for us?
Yeah, as you mentioned, Paul, a lot of earnings stories. So best performer in the S&P 500, I know you guys will be talking about it all day today. Target, as you said, up 18%. Big thing for this company has been inventory management. Well, they delivered improved inventory management. Profit beat expectations for the quarter. That's your best performer in the S&P 500 this morning, ticker TGT. So that paired with some of the economic data leading to a boost for the likes of Dollar Tree and Walmart, other retailers. One other retailer, though, that's the worst performer in the S&P 500, TJX Companies, ticker TJX, down 4%. The expectations and guidance they provided for the holiday quarter, disappointing Wall Street. So you're seeing a bit of a divide when it comes to some of these consumer-facing companies. I will point out, again, second best performer in the S&P 500, Van's parent company, VF Corp, ticker VFC, up 14%.
Wow.
JP Morgan upgrading it on its turnaround plan. One thing to keep in mind, everything's in context. Stock still down 47% in the last 12 months.
I am pretty amazed I know Target beat on the bottom line, and they also beat on sales, but they did have a drop in same-store sales of 4.9%, and that follows a drop of 5.4% in the previous quarter. It's not like there isn't any inflation, right? Prices continue to rise. So to me, those drops look even worse in the face of, 3+% inflation. Like, they still can't get their numbers up. This is not adjusted, this figure.
I know. And what I asked the Bloomberg News reporter earlier today with surveillance is, what's the company saying? Is this just base effect? I'm still kind of dealing with the base effect from the pandemic and people going out and buying everything they can get their hands on, and now they're doing more experiences? Or is it that the consumer is really struggling out there? So, and the response from the management is kind of both, and it was explained to me this morning that Target's kind of in the middle of the price range. Walmart's a little bit lower price point, so maybe they're going to do a little bit better. Target's a little bit kind of in the middle versus, something that might be in a, department store kind of range.
Yeah, a lot of people don't have a choice, though. I mean, you can't go down to Walmart if you're in New York. I know. And there are a lot of people here.
I know.
Who do a lot of consumer spending. I mean, Target's the only choice. There is no Walmart.
Why don't they have a Walmart in New York?
I do not know. I would
there's
love
no
one.
There's no Dollar General or Dollar Tree or anything.
There's no Dairy Queen in New York,
all right,
which I'm still upset about.
All right, and we're done.
I want Warren Buffett to bring that on.
And when is it? You're a California guy. When is In-N-Out Burger coming to New York?
In-N-Out. Well, they're supposedly opening in, I want to say, Nashville this year, next year.
We're getting there.
One of the times.
A little closer.
Which is further away than, Arizona and Colorado. But they're a very particular company. Great burger.
It's just weird that they don't. It's strange that they don't have at least one Manhattan store, right?
Well, because it's family run. They want to run a really tight ship. I've had friends who work there, and they were like, you get paid quite well, but you work your hours. You're not on your phone. If you don't wear the right belt, they send you home. They are a no BS business that likes to be overseen by the family, and they will pop into stores and are more than happy to stop by and make sure everyone's keeping on the straight and narrow.
Retail sales came in. I'm looking at the retail sales that came in on my ECO function. A little bit better than expected, but kind of hanging in there. So, I mean, you know, I'll be interested to see what Walmart says.
And this is, I believe, the first retail sales data we have since student loans are back in play. So interesting to keep an eye on that. But it will be one of the many things we're watching going forward into the holiday season, as you mentioned, just given how critical the consumer has been for the economy. And one company that is consumer-facing, in a way, Advanced Auto Parts, ticker AAP, right now up 2.5%. Kind of a rebound, though. They started out lower, but they cut their forecast, and they detailed some more plans around their divestment plan. But, Paul, as we talked about with Pfizer a few weeks ago, the stock's down 67%. So clearing the decks and maybe being able to draw on some investors could also be a bit of short covering as well.
Yep, absolutely. I'm looking at Disney just to round out the talk of the stocks out here, up almost 3% here. Value Act taking a position, Activist Investor Value Act is taking a position in Disney. And as I was discussing with Tom Keene earlier, man, there's a lot to look at when you look at Disney. If you're an activist investor, you say, boy, I've got a ton of really world-class assets here. And you can just ask the simple question, is the market valuing them correctly in the marketplace today? And if not, then maybe you have some arguments for splitting up the company, IPOing this, spinning out that, all kinds of options. So I'm sure that's kind of what these activist investors, including Value Act, are probably saying. Bailey Lipschultz, thanks so much for joining us. Bailey covers all the markets for Bloomberg News. We appreciate getting a couple minutes of his time. All right, let's go back out to the West Coast, to San Francisco. SpaceX discusses spinning off Starlink via IPO as soon as 2024. I don't know what's going on there, but Ed Ludlow does. He's the host of Bloomberg Technology. He's out there somewhere in California, I don't know where. Sometimes he's in the desert for these rocket launches.
Dude, as soon as late 2024, that's not soon at all.
Exactly. I'm not putting that in my
as
budget.
far away as late 2024. That's like 100 years from now.
Exactly. Ed, what's happening with our good friends at SpaceX?
Yeah, all good points. Look, sources tell us that this IPO, which is a spin-off of Starlink as a separate unit, could happen towards the end of 2024. The end of 2024, we have an election, so bear that in mind. And if not 2024, 2025. And Matt, you're completely right. That is distant, but this is highly anticipated, right? You know, given the recent news flow, Musk confirming that Starlink, which is SpaceX's satellite constellation-based internet service, has reached cash flow break even. That is what he has said pretty consistently over the years would be the trigger to work towards a listing, spinning off through a listing. And what my colleagues and I are reporting is that even though that is far away, they're taking really material steps towards doing that. So for example, one source told me that they're already shifting Starlink's assets, its business assets, its people, to a new wholly owned subsidiary to prepare it to be a sort of standalone unit ahead of an IPO.
The amazing thing to me, you write this in your story with Gillian Tan and a couple of other Bloomberg News reporters. They're expecting Starlink to generate $10 billion in revenue next year, which eclipses that of the rocket launch business at SpaceX. So it's essentially it's essentially their core business at SpaceX, right? At least judged by sales.
Exactly right. It's essentially their core business. So what we reported was that revenue's due to jump significantly next year to around $15 billion. This year overall, it will be about $9 billion with a pretty even split between launch and Starlink. But next year, Starlink will be the vast majority, more than $10 billion. Guys, I just want to say, for sheer transparency with the audience, that as soon as we published the story, Elon Musk responded to a user on X, the platform formerly known as Twitter, who had posted a screen grab of the story, an image of it, and Musk's response was one single word, which was false. So on the face of it, Musk is denying the accuracy of our report. But I would also tell our audience this is not the first time Musk has replied or posted on X about something I've reported saying it's false, that in the end is proved completely true by regulatory or legal filings or otherwise.
I mean, this sounds like a really, cool business, admirable business, kind of connecting parts of the world that, can't get, I guess, internet connectivity besides it. Are there competitors to Starlink out there?
Well, the legacy space-based internet companies like Viasat, for example, but they've just not been able to make this a business in the way or the speed that Starlink has. If you remember, Paul, when I was in New York last week, we talked about Starlink's revenues. And the reason that it's worth discussing and reporting the stepping stones towards an IPO is that this is the mainstay of SpaceX's future, right? Everyone kind of wants an association or investment into an Elon Musk company. SpaceX is a private company. And although there is some liquidity in the trading of its shares on the secondaries market, and from time to time a tender offer where employees can sell shares, there isn't really much opportunity to have ownership of it. So there's a lot of interest here. But Starlink has been a game changer for people to access the internet around the world where they otherwise have not been able to because of the satellite and ground receiver-based technology.
Well, and a lot of people first heard about Starlink because of Russia's invasion of Ukraine, the Ukrainians using Starlink to defend themselves. There is a competitor from Jeff Bezos, right? I can't pronounce it, but it's like Project Kuiper?
Kuiper. Yeah, Kuiper, yeah.
Well, of course, because it's spelled K-U-I.
Well, exactly so. And what they're trying to do is the same thing. Jeff Bezos has a rocket company. It's called Blue Origin. But in the first instance, they're relying on United Launch Alliance to put and other carriers, sort of legacy rocket companies, to put Kuiper satellite constellations into space. They have a very small, like single-digit number of